it's time to start the cutting cycle. But we don't see evidence of a recession yet, and the soft landing is still in play here.
I don't think the data suggests that we're going to have a hard landing anytime soon.
These trends have been underway, they're persisting, and our fear is that the soft landing could be slipping away.
The bad news is no longer the good news. I think bad news is not bad news.
The Fed needs to regain control of the economy. Unless you establish anchors, the volatility itself of the marketplace will undermine economic well-being.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Spent the week with everyone freaking out, and Rabini's kind of chill. I really don't know what to make of that. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, coming into Thursday and heading towards a fourth week of losses on the S&P 500. Your scores look like this. More of the same, maybe. We're pulling back by 0.25% on the S&P 500, down a tenth on the Nasdaq. On the Russell, we're down 0.5%. Yesterday, giving up gains of as much as 1.7% in yesterday's session. Today's data point of the morning, arguably the data point of the week, it's jobless claims. The estimates look like this. 240 is the number we're looking for in our survey. Anne-Marie, the number last week, 249. This one has become more and more important.
A lot more important, and what they are expecting, though, is that a 9,000 drop in those initial claims. Jim Reed this morning, Deutsche Bank, billing it as one of the most important data points of the day and potentially of the week. The increase last week, what we saw, though, there's some seasonality to this. Auto factories are closing. You do have some school closures. Of course, the hurricane in Texas. But yet again, what did Mohamed Al-Arian say to us yesterday? This is a market that feels anchorless. And any data point that comes out, potentially, they're going to want to really get their handle on.
We're at the highs of the year on jobless claims and hoping that we pull back just a touch. The calendar for the month ahead, let's go through it again. I think it's worth revisiting. We have a Federal Reserve decision on September 18th. The meeting begins on September 17th. We've got a CPI report on the 14th of August. Jackson Hole and the speech that traditionally gets given by the chairman, that takes place on August 23rd. Payrolls again on September 6th, CPI on September 11th. Danny, that's the lineup, really, the big data points between now and September 18th.
And the reason it's particularly frightening this time is just how the market is shaped up going into it. We have bond yields basically right back where they were before we got the Friday jobs report. We're talking to Ian Lingen yesterday at BMO, who said that positioning is back neutral. That means the chop this time could happen either way. You get this feeling that the trend has stopped, the trend of before the summer. And when trend stops, you get a lot of instability as we try to grasp on to what the economy is actually going and where it's actually going. That's why these data points are so important.
Dollar yen check, 146 right now. Have we dealt with that? Is that all unwound? Are we finished?
Well, depending on who you listen to, John. JP Morgan says that we are, I think, 3/4 of the way through, but everyone's got their own estimate. If you look at the Bank of Japan meeting minutes, it would suggest that maybe we're not through. It was hawkish. The market has read it as hawkish, and the reaction, you can see that clearly.
Dollar yen right now, 146, pulling back by 0.4%. Bramo's not here. Bramo's back next week. But if Bramo was here, we'd be talking about that soft 10-year auction of yesterday. And looking ahead to this one, a 30-year auction a little bit later this afternoon, $25 billion worth. We'll talk about that a little bit later. Your bond market right now looks like this on treasuries at the moment. We'll start with the 10-year maturity. The 10-year at the moment, your yield lower by 3 basis points. The 10-year 390, 93 in the equity market, pulling back just a touch. We're down 0.4%, and pretty much unchanged for the euro against the dollar at 109.25. The lineup for this hour coming up: Seema Shah of Principal Asset Management as stocks drop ahead of key data. Tobin Marcus of Wolfe Research as Harris makes her way through the Midwest, and Sarah Wolfe of Morgan Stanley on the state of the US labour market. We begin with our top story: stocks sliding going into jobless claims at 8:30 Eastern Time. Seema Shah of Principal Asset Management thinks it will take a lot to end this bout of volatility. Unfortunately for markets, the negativity of the current narrative implies it may take a combination of solid economic data, earnings and reassuring Fed speak to settle nerves. Seema joins us now for more. Seema, let's take it from the top then and go through it point by point. The Federal Reserve, the Fed speak, the earnings and the data. Just where are we at the moment?
We haven't got that much. Unfortunately, there's not much Fed speak between now and Jackson Hole. I'd expect a couple more speakers to be coming out to calm the market. The thing is that, just as we are all reacting to the economic data as it comes out, that is also the case for the Fed. So they can tell us that things don't look so bad. They can reassure us that the labor market doesn't, the payrolls print of last week is just one data point. But of course, if you were to see a continued deterioration in the data, well, the Fed themselves are going to have to respond in kind.
What is driving things here, Seema? What's amazing about this shock of the last week, if we can call it that, is for many people, they're still trying to diagnose the origins of it. Is this a growth scare born in America or the vicious unwind of the carry trade out of Tokyo, Japan? Where do you place the greater emphasis?
Well, I would say that, look, for the last 6 weeks to 2 months, I have seen the number of client queries moving towards worrying about actually recession has been quite surprising. So we've moved away from wondering, is the economy going to continue to accelerate? Is there an overheating? To people really questioning how weak the economy is. So in a way, I do think this is a growth scare. I don't actually buy into it, but I do think a lot of it is born of a growth scare. And then it's been exacerbated by this very, very low liquidity. I think the three of you are the only ones left in New York this week. So that hasn't helped. And then, of course, there's positioning, the carry trade. So it's been a bit of a perfect storm of events. But I think that the growth scare has actually been building up in people's concerns for a while.
Seema, what does that mean for the data coming in, not just this week? John went through the calendar, PPI, CPI, and retail sales next week. Are you worried?
I don't think I'm worried, because I think when we look at the breadth of the data, we do believe that there's still a lot of resilience, particularly in household balance sheets and corporate balance sheets. And what that should mean is that if you were to see a deteriorating labour market, it shouldn't then mutate into a hard landing. But we have to also be aware that job losses can be quite self-reinforcing. Job losses lead to further job losses. At this point, though, we're not seeing layoffs. And a lot of the surveys that we're looking at and just kind of watching companies and how they're reporting, you're not really hearing news of that. But of course, the Fed has to be aware that, look, the labour market deterioration, if it continues, well, then that could feed and create a downward spiral. I think that the CPI data, for the first time in ages, that's not the front and center. It's really about the growth data and in particular about the labor market.
Seema, let me actually ask that question another way. Are you worried about the market reaction? Are you worried that this is a market that is putting too much weight on the negative data that's been coming in?
I don't know if it's necessarily putting too much weight. I think it's a market which is on edge. As I said, exacerbated by the fact liquidity is so low. But I think that from here, the direction is fairly unclear over the next 3 or 4 weeks. It's going to respond to how that data comes out. If jobless claims moves further up today, then I think, of course, you're going to see a negative market reaction. If it falls back a bit, then the market is going to celebrate. And I expect that to be the pattern of market moves for the remainder of the month until you get into September, and certainly post-Jackson Hole. At that point, maybe you can see some stabilization in a really clear direction for the market.
We also have the DNC next month, and I bring this up because Lori Calvasino is on with Manis, and on Monday she put out a note saying that the S&P 500 has now been positively correlated with Trump's betting market odds, which have been deteriorating, now lag Harris. Could politics be also one of those pillars, one of those reasons why we are seeing the markets whipsaw, and we saw that sell-off on Monday?
So I think that the political picture actually played out maybe about 3 weeks ago when you had that huge rotation. I do think that the rotation to a small cap was a little bit about the Trump trade. Things are settled at the moment, but you're right in saying that that election story, it's coming back. It's not like it's disappeared. So come September, I think that is probably going to be, again, near the front of the news story along with the Fed. So we will see that add to the volatility and probably impact the market narrative too.
So if all this about September, should, Danny, John, and I, the last 3 people left in New York, is all of this just noise then?
In a way, it's noise. So, I mean, the thing that we're advising clients is like, look away from the near-term headlines. It's fairly shocking. The moves are very, very significant. But we have to have, I think the most important thing is to have an idea of what your fundamental picture is. Now, it's still unfolding because you're at that cusp where you could be pointing to a stable economy. But then, as I said before, if job losses really start to mount, then it feeds further weakness. So unfortunately, the narrative isn't as clear as it would have been maybe 6 months ago. But the key point is focus on the fundamentals, because the technicals can really whipsaw you around, but it's the fundamentals which are really going to create that clear longer-term trend.
Seema, that's the story. We've got to talk about the price of the story. And in certain parts of the market, we've had quite a big reset. We heard from Barclays yesterday. They were talking about going overweight tech, overweight financials, looking at buying opportunities. Seema, where do you see the opportunities at the moment? Where do you want to be?
So I think the key area is, look, we still think defensive quality. We know we're going into an economic slowdown. We don't think it's going to be a recession, but it does suggest that you need to have a slightly safer element to the portfolio. We do think that fixed income, I mean, it's really proved its worth in the last few days with that negative correlation returning between equities and bonds. And then within, we've maintained an overweight to large cap tech we're keeping it at some point, probably not yet, but at some point will be a buying opportunity as well.
You say we're not in recession, but I have to say in certain parts of this economy, it certainly feels like we are. If you're a low-income consumer right now, it looks and sounds like recession. If you're in manufacturing, based on the ISM we had, it looks and sounds like recession. Seema, are parts of this market firmly in recession?
So you're absolutely right. There are pockets of the economy which are struggling, and that makes sense because remember, like the Fed did hike a significant amount in a really, really short space of time. So there will be pockets which will be struggling. Lower income households, the ones that really don't have the savings, that haven't benefited from that passive income, the rise in equity prices, rise in house prices, they're the ones who are most leveraged to the interest rate environment, and that's where the weakness is. But remember, for the US economy, the medium and higher income households are the ones that really carry growth. They account for about 60 to 70% of consumer spending. So as long as they are okay and the lower income households are not really struggling significantly with job layoffs, then I think the US economy, it's slowing, but we're not heading towards recession. But you're right, there is a very, very differentiated environment underneath the surface for the US economy.
Well, Seema, just given the noise that's been around this earnings season, you would assume that it looks pretty bad, that you've had all these companies from airlines to autos talking about how bad things are for the consumer. But Deutsche Bank's Binky Chaja points out that earnings are on track to rise the most in 8 quarters, at 10% quarter over quarter for this one. Do you take comfort in that? I mean, are we overlooking what is otherwise a strong earnings season?
Yeah, I was thinking exactly the same thing today. When you think about the narrative, you'd suggest that maybe earnings picture has been horrendous this season. It really hasn't. But I think the thing is that we came into the earnings season with people, as I said, really worried about what is happening with the growth backdrop, but also looking at the valuations of some of those big tech firms and starting to wonder if they would deliver. So I think that has almost encompassed the entire narrative and hidden the fact that actually under the bonnet, it doesn't look that bad. There has been a broadening out of the stronger earnings performance, and some other sectors, not just big tech, and actually the opposite of big tech, are really the ones who are performing well. And that is a really, I think, encouraging sign for the remainder of the year.
Seema, it's good to catch up. As always, Seema Shah there, Principal Asset Management, talking about what's under the bonnet. Depends what car you're driving. Just think about this. Let's lift the bonnet on the US consumer right now. Pepsi, consumer is more challenged. The airlines, we're losing pricing power. That's a story, by the way, you heard on both sides of the Atlantic. Not just the US players, but the likes of Ryanair as well. Kimberly-Clark, slower price increases. Disney yesterday. Low-income consumer is pulling back. And then they said something that I'm still scratching my head about, that we'll be back in business, we'll be bouncing back by the middle of next year. And I'm still sitting here thinking, where does that come from? What drives that?
Right. Is it people who are middle upper class not going overseas anymore and instead going to Disney, which you actually might assume that could be generally a bad thing for the economy because people aren't spending as much? There was a decking company yesterday. They're called Trex, and I thought their earnings were specifically interesting because on the earnings call, they said, look, we don't have lower income consumers, people who want to redo their decks in a really fancy way. They don't tend to be lower income. Instead, we have middle income consumers, and they are struggling. They are struggling, and they don't want to do renovations to their house anymore. So we've been talking about the lower end consumer, but there are kind of hints it might be climbing up.
Is this migrating up to high income consumers? And I think that's a big question. I think it was Chris Harvey of Wells Fargo that was asking that question a few weeks ago. Starting to see just a little bit more evidence of that. Let's take the opportunity to get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. Taylor Swift's 3 shows in Austria this week have been canceled after local police arrested 2 people on suspicion of planning a terrorist attack. A government spokesperson saying the decision was made by the event organizer. Officials found chemical substances at the home of a 19-year-old Austrian citizen and later detained another person in Vienna. Shares of Warner Brothers are down more than 12% in the pre-market. The parent of CNN and TNT posted a second quarter charge of more than $9 billion after writing down the value of its traditional TV networks. The write-down reflects the continued exodus of viewers from cable networks like CNN to new streaming platforms. On that note, Warner Brothers said it added 3.6 million new streaming subscribers, almost double what Wall Street had expected. And shares of Bumble are plunging nearly 40% in the pre-market. The dating company reporting second quarter revenue that missed estimates and slashing its revenue outlook for the year. In contrast, Match, which owns Bumble's biggest rival, Tinder, jumped the most in nearly 2 years last week when it delivered better than expected quarterly results. That's your Bloomberg Brief. John?
Yahira, thank you. Let's stop getting hammered. More from Yahira in about 30 minutes' time. Up next on the program, the battle for swing states.
I just wanted to check out my future plane, but I also wanted to go say hello to the vice president and ask her why Kamala Harris why does she refuse to answer questions from the media?
That conversation up next, live from New York City this morning. Good morning. Equity futures on the S&P 500 slightly negative. If you are just joining us, welcome to the program. In the bond market, sloppy 10-year supply yesterday. That shook up this bond market a little bit firmer this morning. We're down by 2 or 3 basis points, 391.69 on a 10-year. That's the market under surveillance this morning. The battle for swing states.
I just wanted to check out my future plane, but I also wanted to go say hello to the vice president and ask her why Kamala Harris why does she refuse to answer questions from the media? And I also thought that the press gaggle following her might get a little lonely. I at least have enough respect for you all and for the American people you report to come and talk to you and to answer some questions. And so I thought her reporters might actually benefit from that as well.
I think that was met with the sound of silence. Here's the latest. The Harris-Walz ticket is heading to Phoenix, Arizona for the next stop of their swing state tour. J.D. Vance shadowing the campaign with his own rallies to undercut recent momentum behind the Harris campaign. Tobin Marcus of Wolfe Research writes this: we still think it's premature to consider Harris an outright favorite, which still give a slight edge to Trump. Tobin Marcus joins us now for more. Tobin, great to catch up with you, sir. As always, seen just a full aircraft hangar. And it just reminded me of like 2016 and Donald Trump. They seem to be taking a leaf out of his playbook from 8 years ago, Tobin, and it looks to be highly effective. They look like they have some real momentum in the Harris campaign. Yet J.D. Vance is right. We haven't heard Harris answer any questions at all, with the exception of standing on the tarmac following a prisoner exchange. And Tobin, I wonder if that's going to change at all anytime soon, and whether actually it needs to.
So right now, I think they are trying not to mess with the good thing. It's been a very, very, very good 2.5-week run for Harris since she took over the top of the ticket. And I think that they are reveling in the momentum that they're seeing out there and sort of not feeling the need to take any unprompted questions if they're getting their message across. Right? The point of the campaign is to deliver their message. They feel like they're doing that. They're getting tons of earned media, most of it positive, but certainly there's no lack of attention. And so I think they are not going to feel immediately compelled to change their media strategy. Although, as the campaign goes on, I do think that we're going to have to see a little more kind of unprompted answering of questions. But I mean, frankly, both Harris and Trump are not taking a sort of press conference forward approach. We're seeing a lot of appearances on alternative media. Trump going on, I guess Kick was the streaming platform that he was on the other week, which sort of similarly is an unorthodox media strategy.
Right, but he also did just sit down with our colleagues at Business Week to talk about a number of policies, something we haven't seen from Kamala Harris. At what point do you think they'll actually come up with an agenda for what their policy plans would be if they win the White House?
Well, they have to put out a platform for the Democratic National Convention, which is in 2 weeks. So we'll see something before too long that sort of purports to be the official agenda of the Democratic Party. And those platforms generally are not that informative about what anyone is planning to do. They're a little bit of an interest group management exercise, particularly on the Democratic side. Trump took a more active role in setting the RNC agenda this year. And frankly, I think it would be wise for Harris to sort of similarly lay out something that's kind of streamlined and reflects what she personally wants to prioritize, rather than some incredibly detailed, 14-point plan on every single policy issue under the sun. So, before too long, we should see her put out something. But, it's a short campaign. The shorter the campaign is, the less I think she's going to have to answer all these tough questions about exactly what's your agenda on paid family leaves. You talk about that. I think probably she can just sort of state a priority for the issue that she wants to focus on and leave some of the details for after the election.
The short campaign works for her. And Washington Post had a story where the former president, Donald Trump, apparently said to someone, I already beat Biden. Now I have to go out and prove myself against her. How should the Trump campaign be dealing with this? Because we just showed pictures of her rallies. She's getting a lot of people, and there's a lot of excitement around her and her new VP pick, Governor Walz.
Well, their strategy, I think, has always been to portray her as kind of dangerously liberal and out of step with the American people based on her past positions that she took in the 2019-20 primary. She committed to various different things that I think are problematic. One of the reasons why I don't yet consider her a favorite, even though the polling has looked very strong for her, along with that enthusiasm on the ground, is that we haven't really had a chance to see whether or not those attacks are sticking yet. They have not been delivered in the most disciplined way, I would say, from the Trump side. And I think the way that they're intending to tap walls onto that, sort of attacking nice Minnesota as a socialist hellscape, seems a little bit challenging. But there is plenty of ammunition they have to go after Harris, and we've only started to see that effort come together.
Tobin, that's the content of what they're saying. I want to ask you about how they're saying it. We haven't seen Trump at a rally since Saturday when he was in Georgia. Instead, it's been J.D. Vance, who's been out throughout the Midwest. What do you make of that tactic, that they're basically sending him out to appeal to these voters?
Well, look, I mean, J.D. Vance is from the Midwest. His electoral track record is not particularly impressive in the Midwest. So I don't know how he's going to do as a voter. You know, in Ohio, he ran behind Trump, and he ran way, way, way behind the governor, the Republican governor, who is sort of substantially more popular figure. So he has some affinity, I think, for that part of the electoral map. But it remains to be seen how effective he is as a messenger. You know, Trump's not been running the most sort of vigorous campaign, more so than Biden back when he was on the ticket. But I think on both sides, we do have guys who are a little bit kind of probably past the peak of their powers in terms of their ability to just sort of run a really, really, really aggressive campaign 5 days a week. So, you know, if they want those attacks to stick, I think they are ultimately going to have to get Trump more out there rather than just posting about her on Truth Social.
Tobin, it just feels like he's trying to beat a man he's already beaten. He's still trying to beat Joe Biden. And Tobin, I wonder why he's finding it so difficult to pivot. We talked about these pivots in the campaign. Clearly the Democratic ticket had to pivot. It's done a great job of doing so. You can see the enthusiasm in the party. You can see that reflected in the polls. Why do you think this campaign is struggling so hard to pivot?
Yeah, so the campaign organization, I think, is pivoting reasonably well. I think if you look at Trump's kind of campaign leadership, they're not feeling too wrong-footed by the need to go after Harris. They feel like they have plenty to say about her, even though, again, that message has not yet come across, and time will tell whether or not they succeed in getting this sort of negative attempt to define her across. But Trump himself, yeah, really does seem to be struggling. I guess there's been a lot of intrigue in D.C. about what exactly is meant by this comma blah nickname that he tries to be, that he seems to be trying to roll out. So it does feel like he personally is sort of throwing some things at the wall and seeing what will stick. Again, we do have 90 days left in the campaign, so he has some time to see if he can make it happen. But for now, not the most effective effort from him.
Tobin, this was great. It's good to hear from you, sir. As always, Tobin Marcus there of Wolfe Research. Look, we're still early August. Got a long way to go. And I know a lot of people sit here and say it's a short campaign. Well, we've seen how much can change in just a single month in American politics. But when you sit here and just take stock of where the momentum is, who's got the momentum, it's pretty clear that one ticket has the momentum right now, and the other ticket has kind of lost a lot.
Absolutely. It's the Harris campaign. They have momentum. They're doing the splits across the U.S. Does that change when she starts to talk about policy? She's very good in these moments. Even yesterday, there was a heckler, and she immediately shut that person down. And the crowd there actually supported her doing that. How does Trump change? In this Washington Post article this morning, he says to an ally on the phone, "It's unfair that I beat him, and now I have to beat her too." It almost feels like they haven't come to the fact that this is a new election. It's just a brand new race. That's what it is.
They're struggling to adapt. And by they, I mean the former president. You can see that quite obviously. If you are just joining us, equity futures negative here by 0.2% on the S&P. Coming up on this programme, we'll catch up with Winfin of Brown Brothers Harriman on the unwinding of the carry trade from New York City. This is Bloomberg. from New York City. Welcome to the program. Check out the price action together. Equity futures pulling back just a touch. We're down by about 0.2%. The highs of the session yesterday positive by about 1.7, and then pulled back to negative territory on the S&P 500. We're adding to those losses just a touch this morning. That rally disrupted somewhat by developments in the bond market. So let's look at the bond market. A disappointing bond auction following a ridiculous rally. This bond market caught offside on a 10-year. We're down to about 391.69 this morning, down 2 or 3 basis points. I keep saying this, you've got to think about where we were Monday at the lows on a 2-year. We were at 365, so 30 basis points south of where we are right now. We're down about a single basis point at the moment on a 2-year. Danny, we talked about that 10-year auction. We get a 30-year a little bit later this afternoon, $25 billion worth of 30-year bonds.
Yeah, I mean, it was not a good auction by any stretch of the imagination. Jim Bianco points out that it is tied for the 3rd worst over the past 7 years. If we extrapolate this out, if all of a sudden we're not willing to pay when yields are below 4%, what happens when the economy turns? What happens when yields are much lower? And we have to think not only about that, but of deficit concerns. I think that's when you start to say, okay, we could get some real pain at these auctions.
Political outcomes as well. If we have one candidate who succeeds and ultimately wants to extend all the tax cuts from a few years ago, you've got a very different supply picture potentially to grapple with as well. Zach Griffiths of Credit Sites had this to say about the auction of yesterday. The repricing following what was really just a moderately weak payrolls report seems way overdone. We were caught very offside going into that auction, according to the likes of Credit Sites. That's the bond market. I want to talk about foreign exchange just briefly and give you a snapshot of where dollar yen is trading at the moment. Dollar yen at the moment is down to about 146.26. We're down 1/3 of 1%. More in Japan in just a moment. Under surveillance this morning, traders bracing for jobless claims at 8:30 Eastern Time. Our survey expecting initial claims to come in at 240,000. That would be coming down from the previous week at 249. The figures in sharper focus, obviously, after that weak July payrolls print on Friday. This number, I have to say, it's like the most important jobless claims number I can think of now for a number of months.
Yeah, I mean, I've heard people saying it's basically the most important since, pandemic 2020, when all of a sudden you had this huge upheaval. And it is because we just feel like we're in this no man's land. We've been talking all year about how we've had this narrative pendulum swinging back and forth. At least the pendulum was staying on one side for a couple months. Now it feels like the pendulum is swinging day by day. And each data point we get, the pendulum swings another way. And we've seen what that can do to markets. We've seen how violent both the rally and the unwind can be, which makes this such an important print.
It's so important, but there's so many seasonal issues that can impact this number, which is why I find it almost like hard to imagine that the market wants to put all their eggs in the basket when it comes to this one print. Mohamed Al-Arian had this to say earlier this morning on Twitter leading up to this. Above 260,000 would feel renewed concerns about the health of the labor market and increase these recession risks. Already we see more banks coming out, increasing that probability. And then below 230,000 would point to gradual and orderly normalization rather than something worse. So I'm trying to look at that range.
This isn't just important because of the data we got last week. It's important because this is all we've got. There's nothing else. We've just got jobless claims. We've just got jobless claims, and early this week we just had ISM services, and then for next week that's when you get a little bit more data. But for this week, this is basically it. So that's the US side of the trade. Let's talk about the Japanese side of the trade. The summary of opinions from the Bank of Japan's July 31 meeting showing officials didn't see their rate hike as policy tightening. Comments suggesting they didn't expect the move to be big enough to disrupt global markets. This coming, of course, after the BOJ said it won't raise interest rates when financial markets are unstable. Mike McKee would say this about the Fed, that you can massage the Federal Reserve minutes to kind of guide them to where you want them to go, to send the message you want to send. Was the message received loud and clear out of Japan today?
Well, you do see strengthening in the yen. So in one way you can say, yeah, but a lot of people looked at this and said, it's stale. It doesn't make sense anymore to read this as hawkish because we did have the deputy governor come out and say we're not going to hike when markets are not calm. But I think you look at something like one policy member saying that rates need to go to 1% to reach neutral when they're just 0.25% now. The market might be right in interpreting as a hawkish and not just stale commentary.
You touched on this in the immediate aftermath of this mess, and I think it's so important. What happened? Was this market shakeout the result of a growth shock in America, or just triggered by what happened in Japan and exacerbated by the carry trade unwind? If it's the latter and not the former, but the Fed believes it's the former and not the latter, don't you have a bigger problem?
I'm going to be honest, I'm having a hard time keeping track because it is this weird circular thing that keeps happening. If anything, the problem is is that it didn't really take much. It was a couple things coming together, right? It was 15 basis points of a hike. It was us worried about AI. It was us worried about a growth scare. The driver almost doesn't even matter. It's that the market is so vulnerable and can be set off on these various drivers that we can't even pinpoint at this moment. So when you get a quiet week like this, when you have a summer that people aren't trading a lot, it gets you worried, again, about jobless claims, and it gets you even more worried when you have huge data points next week.
Particularly if there's only 3 people left in New York City, according to Seema, Shah, and apparently it's us. I don't quite believe it, but here we go. JP Morgan saying 3/4 of the global carry trade has now been unwound. Strategists writing in a note the returns in a group of G10 emerging market and global carry trade baskets tracked by the bank have fallen about 10% since May. Win Thin of Brown Brothers Harriman joins us now for more. Win, it's great to get your insight on this FX market, sir, so let's dive deep into it. How much of this mess have we unwound? What's left?
Well, first of all, thanks for having me. It's always a pleasure. At this point, I think it's all guesswork. We can look at balance sheets, et cetera, after the fact, but this is really quite a moving target. So to me, the carry trade has always been this sort of huge amorphous blob that we can sort of take a stab at, but we sort of ignore it until things kind of blow up. I would just say that going back to your comment earlier, I totally agree that this was a very pretty much a perfect storm. Any of these events by themselves, the BOJ tightening, the dovish Fed, sort of softest U.S. labor market, probably wouldn't have had much impact. But all three together, along with what I think the most important thing is the positioning, led to a really outsized reaction. Market was so one-sided, so complacent about loading up on risk. To me, this unwind, I think, still has quite a bit to go. I think the one thing I'm very confident about is that volatility remain high, regardless, really going into the fall and perhaps even year end.
When you say quite a bit to go where? Let's just pick a trade, pick a currency pair. Let's say dollar yen. When you say quite a bit to go, what do you mean?
So by quite a bit to go, I mean that to your point earlier, that we don't really have a handle of how the U.S. economy is going, how the global economy is going, and there's a lot of fear right now. As you point out, there's no data this week. Next week we'll get inflation, retail sales, but even then, I don't think that's going to assuage these concerns. The markets have really jumped on this bandwagon of U.S. recession, dovish Fed, and it's going to take a while to sort of unwind those expectations. As I like to point out, the market's been totally wrong about the Fed easing cycle, this whole entire cycle. I think they're wrong again. We're looking at 100 basis points being priced in by year end, something like 200 basis points total over the next 12 months. That is a deep recession. That's the only way we get that rate path, and I just don't see it. The U.S. economy is still holding up. So by quite a ways to go, I think that volatility will remain high as markets wrestle with the data, sort of wrestle with the narrative. But I remain confident the U.S., for now, at least for 2024, is going to avoid recession.
It's one of these weird things, because you talk about this idea that we've, basically we overdid ourselves, that we were too confident, we were complacent. How complacent are we at this very moment? Are we still complacent?
No, I think the markets are actually overly fearful. Again, pricing such an aggressive easing cycle suggests the markets are really concerned about the growth outlook in the U.S., the global growth outlook. So I would say the complacency has definitely sort of morphed more into fear, or I think overly fearful. I'm not saying, look, take break at the champagne and all is good going forward, but I think as you know about the pendulum, it always swings. I think right now the pendulum swung too much in the sort of negative U.S. recession territory.
But when the pendulum swings, I mean, you can be caught really offside in this market. When you can be caught offside in the matter of days, how quickly things are flipping. What do you do with that? How do you want to position and stay in this market when that pendulum is swinging at hyperspeed?
Yeah, no, that's a problem for analysts. And I think my rule of thumb is don't panic during a move. I'm not going to name names, but several banks came out and changed the Fed calls in the middle of this Fed panic, in sort of this market panic. And that's exactly the wrong time and the wrong signal to send to clients. I think you have to kind of look through the noise. This is my philosophy. Look through the noise and look at what's the true signal. What's the fundamental story? And to me, the U.S. is growing somewhere around 2-3% in Q3 after a 2.8% print in Q2. Momentum remains strong. That's why I think there's no recession this year. The momentum is pretty strong going into Q3, Q4. 2025, well, that's a different story. We can revisit that. But near term, again, I think the fundamental story really hasn't changed, say, from 2 weeks ago. Yeah, the economy's slowing a little bit. There are pockets of weakness, but overall, the U.S. economy remains in solid shape, and that's the story I like to tell.
Well, when you look at pockets of weakness, what exactly are you looking at?
Well, clearly, the labor market. As you noted earlier, the claims are edging higher. The Somm rule that we've all been talking about has been triggered, but even Claudia Somm herself has said, "Look, everyone hates to say this, but hey, this time it's different." She points to growth in the labor force as the major factor behind the rise in unemployment, rather than layoffs and job elimination. So, again, there's so many moving parts. I just want to bring this back. One last final point about the carry trade. It's not just about currencies. One of your reporters dug up an IMF article from, I think, 2008, 2009 that suggested that the carry trade is really a big factor in the great financial crisis. It's borrowing in yen and investing in just risk assets, not just high-yielding currencies, but things like mortgage-backed securities and things like that. So I think that's another reason why we had such an outsized global, multi-asset meltdown last week. It's this carry trade goes beyond, just sort of currencies.
I want to also get back to your point about the fact that you think the market is overpricing in how many cuts we're going to get from the Fed this year. If it's not 100 basis points, where do you put it at?
I think, September is clearly a go. I think, to me, it's a debate whether it's 25 or 50. But I don't think the Fed is in any rush. If you look at financial conditions, they remain quite loose. Yeah, sure, we had a little tightening last week with the equity market meltdown. But to me, the market is doing a lot of the heavy lifting for the Fed, even without cutting rates. The Fed has seen some easing already ahead of the September 17th, 18th meeting. Mortgage rates are at 2-year lows. So again, my base case is for a soft landing in the U.S. economy, and that to me does not sort of argue for a really aggressive easing cycle that the market's priced in.
Well, before you go, let's just finish on the carry trade, and let's sort of park these cryptic stories about these kind of spooky, mysterious hedge fund managers that are going around shorting one thing and buying US tech. Can we just talk about the Japanese investor? I just want to understand how dominant the Japanese investor has been in being structurally short their own currency and being long assets around the world, and whether that money is going to start to come home now after what the BOJ started last week.
Yeah, Jonathan, that's a great point. And that was always sort of the 800-pound gorilla that was sort of in the room before the BOJ started tightening. Japanese capital has been sloshing on markets for decades. So I would actually it's a good thing you point that out. We just had June current account data for Japan released overnight, and it showed that there were large sellers of foreign bonds, especially U.S. Treasuries. Now, look, 1 month I think it was the biggest sale in nearly a year. Look, 1 month of data is not a lot to hang your hat on, but it's definitely something worth watching. As Japanese yields go up, we should see a natural sort of home bias come back. As domestic yields become more attractive relative to the U.S. and the U.S. is cutting, and the rest of the world is cutting, we'll definitely see sort of a rebalancing. So definitely something to keep an eye on. At this point, the flows, I don't think, are disruptive. It's more, I think, the hot money and the carry trade that's doing the volatility, so heightened volatility, but definitely worth keeping an eye on.
One to watch. Win, it's great to catch up. Thank you, sir. Win Thin there of Brown Brothers Harriman on the latest in the FX market with dollar yen at the moment. Kind of muted price action, just about unchanged on that currency pair. I guess that's good news for you all. 146.26. We're down on that currency pair by about 1/3%. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Delta Airlines has been hit by a class action lawsuit. The company is accused of failing to properly refund flyers or provide passengers with meal, hotel, and transportation vouchers after CrowdStrike's software outage last month caused widespread delays and cancellations for the airline. CrowdStrike is also facing lawsuits from consumers and investors over the outage. Meanwhile, investor Kathy Wood is trying to take advantage of the recent stock market sell-off. She scooped up shares of tech firms just as her flagship fund sank to a new 2024 low. Wood's ARK Innovation ETF bought shares of Amazon, Advanced Micro Devices, and Roku. Meanwhile, a fintech-focused fund of her firm also added Reddit and Meta platforms. And Manhattan renters are shifting to smaller apartments in a bid to avoid paying more in rent. The average size of an apartment leased in July was just 945 square feet. That's a decline of 9.5% from a year ago, according to Miller Samuel and Douglas Elliman Real Estate. The square footage has declined on an annual basis in each of the past 11 months, while the price per square foot has risen. That's your Bloomberg Brief. John?
I just realised when Seema Shah said under the bonnet, you guys didn't know what she was talking about. Under the hood.
We've all lived in
London. We say
London.
under the hood.
Yeah.
Okay, but you guys, I mean, like, Does that translate?
It does. Well, I love the colloquial phrase, like there's a bee in your bonnet, which it just sounds so folksy to say, like, under the bonnet.
But that's the hat, right? The bee in the bonnet?
Oh, isn't
that what that is?
Yeah, I guess so. Bonnet means more than one thing?
It means the hood on the... Okay.
Learn something new every day.
Maybe we didn't get it.
I think we've confused ourselves around this table now. So I want to pick up on that story from Miller Samuel. Jonathan Miller had this to say: the lower mortgage rates fall, the more pressure is released from rental market prices. How many times have we talked about this? What's going to happen with the cost of shelter when the Fed actually starts cutting interest rates?
Yeah, well, the fear is they cut. Everyone's like, great, mortgages are going down. Let's get into this market. And supply still hasn't caught up with it. So we could very well be in a world where they cut and prices go up.
It's just not obvious what happens here at all. Up next on the programme, when cooling turns to cold.
There's a lot of risk out there to the downside in terms of the labor market. The problem here is when the labor market starts to deteriorate, confidence starts to decline. And when market sentiment deteriorates, that can be self-reinforcing.
Just how self-reinforcing is all of this? That conversation up next from New York. This is Bloomberg. Punchy upgrade from Lilly. Eli Lilly seeing full-year revenue 45.4 billion to 46.6 billion. They had seen 42.4 to 43.6. That's the latest on Eli Lilly. That's stock up in the pre-market. Take a look at this, up by 9%. Compare that to Novo Nordisk yesterday. Two very different stories. We'll come back to that a little bit later. The stock doing nicely, though. Under surveillance this morning, when cooling turns to cold.
Looks to me like the labor market is cooling off quite significantly. We've also triggered the so-called SOM rule, where if the unemployment rate rises by more than 0.5% over a 12-month period, every time that's happened, we've ended up in recession. So there's a lot of risk out there to the downside in terms of the labor market. The problem here is when the labor market starts to deteriorate, confidence starts to decline. And when market sentiment deteriorates, that can be self-reinforcing.
So here's the latest. A light week of data has all eyes on jobless claims due in about 90 minutes' time. The median estimate in our survey calling for 240,000 claims. Sarah Wolfe of Morgan Stanley saying the economy remains on a soft landing path, writing this: churn in the labour market has moderated, indicating that demand for labour is softening. The most recent payroll print showed a meaningful slowdown, but the recent trend remains firmer. We expect the unemployment rate of 4.2% by Q4, 4.5% by the end of next year. Sarah joins us now for more. Sarah, that's a very constructive outlook on the labour market at a time where a lot of people are quite worried about where this is going. Where does that constructive outlook come from?
We have to remember that the employment data is very noisy. So it's not the first time that we've gotten a weak payroll print over the last year, somewhere around the 100,000 marker, just to see it reverse out the next month. So it's very difficult for us to extrapolate forward 1 week payroll print into a hard landing and a 50 basis point cut in September without a string of weaker payroll prints. So if we look back at the recent trend, the 3-month moving average, the 6-month moving average for payrolls is closer to 170,000 to 200,000. It's nowhere near that 100,000 marker. We'll get a lot more clarity on how much of the weak payroll print was weather related. We had a hurricane in Texas in July, and we're going to get that on August 16th, 10 a.m. in the state payroll data. I think that'll give us a little bit of a better sense of how much of the weakness was true weakness or how much of it is weather and is going to be reversed out in August.
Sarah, I want to talk about the self-reinforcing mechanism that Bill Dudley touched on. Let me share that line with you again. The problem is when the labour market starts to deteriorate, confidence starts to decline, and when market sentiment deteriorates, that can be self-reinforcing. But then I look at your outlook for unemployment, falling back to 4.2% by the end of the year, 4.5% from the end of next year. What do you think Bill and the people who think this way at the moment are getting wrong?
I do think that there is some self-reinforcing element. Not only does having a job right now impact how consumers spend, but it's also employment expectations. So if you start to see some people getting laid off, then you start to get more worried about your own job prospects and pull back consumer spending. The reality is, however, is that the unemployment rate is moving higher, but a lot of that is being driven by labor supply as opposed to actual layoffs. If you look at the JOLTS data, the layoff rate is still quite low. The jobless claims data we think is a little bit overstated right now. We saw a similar pattern last year due to some wonky seasonal factors that lifted up initial jobless claims across the summer. only to revert back down in late August and into September. And so we do think actually that jobless claims this morning will show another increase in line with the similar seasonal pattern that we saw last year before starting to tick back down again. And so I really do think it's a matter of the unemployment rate is rising, but it's not necessarily due to layoffs becoming broad-based. It's more because of this rebound in labor supply that we're getting.
The data, to your point, Sarah, as you say, it is so noisy, and it's got an immediate reaction across the street, people upgrading how much they think that the Fed is going to cut. Do you think this kind of sentiment in itself, kind of what John was asking here, the sentiment, not necessarily the numbers, is it enough? Even if there is strength under sort of the headline number, is the sentiment bad enough that you get companies reacting, you get them laying off people?
This is not the first time we've seen this. We've been in a very volatile market pricing environment the last 6 months. If we remember going into the end of 2023, market pricing was very aggressive for cuts this year because of a hard landing. And then that almost fully reversed out. And we were basically at one cut for the first half of this year. And now we've just recently seen this extreme move. And so this is not the first time that market pricing has moved around and businesses had to adjust their expectations. I think that the reality is that they're going to have to be patient about the actual data. What the data is showing us is actually consumers are still spending. It's slowing, but they're still spending. So businesses are still seeing decent unit sales. And so I don't think that we're at the point yet where things are tipping over the edge and we're going to start to see layoffs. And I don't think that we're yet at the point where the Fed's going to have to start cutting 50 basis points. I do think that businesses are constantly being swung around by markets, and we just need to be patient while that pricing comes back out.
Well, the Fed certainly sounds like you, Sarah. They've been arguing for this patience. And this is where the criticism comes in. This is something Mohamed El-Erian spoke to us yesterday about, this idea that the Fed doesn't have a reliable policy framework. And that means that we get swung around by each individual data point. Is that a fair criticism of this Fed?
It is somewhat fair that the Fed is just as good as forecasting the data as we are and just has the same tools that we have to understand what's happening in the economy. And to be fair, it's been a very complicated economic environment the last couple of years. The Fed was very focused on slowing GDP growth, very focused on slowing the labor market a year ago in order to bring inflation down. We discovered that they didn't need to do that in order to bring inflation down. So they had to basically readjust their communication around what they considered restrictive policy. And so I do think that it's a little bit tricky to do Fed watching because they're updating their views and their understanding of the economic outlook in real time, just the way we are. But the one thing we know about the Fed is that they're patient. They look for trends, and the markets tend not to react that way. So that's where we put our economist hat on, and we try to be patient. And we try to look at the sequence of data and what we would need to feel confident, not just recency bias about recent swings up or down, because the data is very volatile.
Well, speaking of the sequence of data, John's point earlier was the fact that we're so focused on claims today because it's the only point we have. Before we hear from Powell at Jackson Hole, what are you most interested in? Because we have a slew of data as well next week.
Yeah, so we're going to get the jobless claims data today. As I mentioned, we're expecting it to actually increase. What we're really looking forward is next week's jobless claims data and in 2 weeks' time from now to see that trend starts to come lower. That's going to be very important for us. The other is going to be Texas, the state payrolls that we get next Friday, 10 a.m., to see how much of the weather effect. And then, of course, as we get into next week, we get retail sales. We have actually a very weak expectation for retail sales, negative 0.6% on that control group retail sales. One thing to keep into consideration is that there's a very unfavorable seasonal factor that's causing quite a big drag on retail sales that we would expect to reverse out in the August and September data. So I do think, of course, markets are probably going to see that negative retail sales print, see it as another point of soft data that's going to worry them, but we're saying calm, stay calm. We're probably going to see that reverse out in the next two data prints because of seasonal factors. And then the last one I'll mention, of course, is going to be the CPI print that we get also next week. We're looking for 0.2% on core CPI and 0.2% translation into PCE inflation. And that's very much in line with the continued trend to get the Fed to cut in September. Of course, markets are going to be very sensitive to any type of upside, maybe saying that it's stagflation, and any type of weaker print saying that this is just further evidence that the economy is slowing too much and the Fed needs to cut more.
I'm not sure anyone can handle a conversation about stagflation next week. Let's hope that's not the conversation we're going to be having. Sarah Wolfe there of Morgan Stanley. Looking ahead to CPI next Wednesday. There's a very simple bearish story to tell, isn't there? Companies are losing pricing power, sales are sliding, margins are at risk, you start cutting costs. Is labour at risk? That's the conversation we're having going into jobless claims. Coming up next, at a second hour of Bloomberg Surveillance, Dan Greenhaus of Solus, James Lucier of Capital Alpha Partners, Bloomberg's Charlie Wells, and Tony Rodriguez of Nuveen. From New York, you're watching Bloomberg TV.
If you look at the fundamentals, at the macro data, yes, it has been weakening a bit in the US, but it's not a disaster from my point of view.
The problem here is when the labor market starts to deteriorate, confidence starts to decline.
We're in one of those classic moments in financial markets where the prices have changed more than the facts have.
I think the market has slightly overreacted in its assessment of a recession.
The markets are often wrong about what's going on with the economy and what the Fed is going to be doing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. Let's do two things, a flavour of the price action, and then we'll talk about the data point that everyone's talking about. Equity futures right now on the S&P 500, a little bit softer, but recovering. We're down 0.1% on the S&P. The Russell down 0.5%. Here's the data point that everyone's talking about. Why are we all talking about it? Jobless claims always matter, but it matters that much more this week because it's all we've got. Jobless claims right now, the estimate 240,000, down in the previous number, 249.
Just listening to Sarah Wolfe, I'm starting to worry about how much importance we're putting on this, because she said, look, this is a data point that's still going to be extremely seasonal. You're still going to have issues in it, like that of last month when you had a lot of weather-related claims coming in. So what happens if this market panics and then we get next week? What happens if it comes weak and then next week you get strong data to the good way? I mean, again, whipsaw, more of it.
Well, let's talk about the totality of the data. Let's go on the data of the last week or so. Does it confirm or deny the growth scare that everyone seems to be talking about at the moment? ISM services clearly denied, back in expansion territory, new orders, business activity pretty decent. ISM manufacturing clearly confirms the employment component of that the worst since 2020. Payrolls confirms the unemployment rate, I think, the highest since 2021. And that's the game we'll be playing, confirm or deny, going right the way through that to that Federal Reserve decision on September 18th.
You get the feeling, though, that the market is putting more of an emphasis on the bad data, that you do have a market that's more willing to react in a volatile way. And that comes back to this positioning conversation that we've been having. But if you have yields back right around to where they were before the Friday's job number, which is just remarkable, by the way, considering the chop that we've had, does that mean that we could have this time around, the bias is a reaction either way, that you could have big swings? Again, for the most part, it's more the bad data that we decide to swing around, but it's anyone's guess this time.
But when you think about a growth scare, you are seeing banks start to up their probability potentially of a recession overnight. That was JP Morgan. They're upping their probability, and they talk about hints at a sharper than expected weakening in labor demand, early signs of labor shedding. But something Sarah Wolfe said that also Torsten Slok talked about yesterday, which was this, everyone talking about the Somm rule. What Claudia Somm is saying is that it doesn't really work this time because look at the supply we've had in the increase of immigration into the United States.
We'll keep going back to the calendar as the path to September 18th of the Federal Reserve and work backwards. The data and what else you need to be looking at the moment. Payrolls, that comes up on September 6th. We get some CPI data on the 14th of August and September 11th. And, of course, you get Jackson Hole on August 23rd. So Chairman Powell's got a bit of time here, Danny, to work out what he wants to say in Jackson Hole. I imagine that speech isn't written just yet, and we've got to wait for the data next week as well.
And this is where the criticism comes in that Mohamed El-Erian has been talking about, that the Fed doesn't have a coherent economic policy framework. And if they did, then maybe Powell could have already written a speech and he wouldn't be swayed by each individual data point that comes in. But the fact that they don't have that means that they need to be so data point dependent. And again, the criticism goes that they're being blinded, that there is a clear trend developing, but they can't see it because they care so much about the individual releases.
We talked lots about the equity market. Let's just touch on the bond market just briefly. A snapshot of where the 10-year is trading following that soft auction yesterday. Yields coming back in just a bit. We're down 3 basis points on 10s, 391 on a 2-year at the front end of the curve. We're down 2 basis points, but still about 30 basis points higher from where we were at the lows on Monday morning. We're trading in the 390s on a 2-year this morning. Coming up this hour, here's the lineup for you. Dan Greenhaus of Solus with stocks falling ahead of jobless claims. James Lucier of Capital Alpha Partners as the election swing state tour rolls on. And Tony Rodriguez of Nuveen on whether the rally in treasuries has run out of steam. We begin with our top story. Stocks edging lower going into jobless claims at 8:30 Eastern Time. Dan Greenhaus of Solus writing this. The economy is clearly slowing, but I don't believe we're already in or immediately at risk of falling into a recession? Dan joins us now for more. Dan, let's get straight into it. Why?
First of all, I'm upset because everything you guys said in your intro was the points I was going to make.
We can pretend it didn't happen if you want. But start again.
But that said, I think we're obviously having a growth scare right now. That's not breaking news. But I also think we're putting a lot of weight on one data point. And to borrow a phrase you used, one of many I was going to, about the totality of the data, it's one singular data point that I would argue, and I'm not alone, but I would argue is probably impacted more by Hurricane Beryl than the BLS immediately led on. I think there are a number of data points you can point to. We're well aware of them at this point. The most obvious one being the number of people not at work due to bad weather, which spiked during the month. That doesn't necessarily impact the unemployment rate per se, but it does indicate that there was something going on in the month that I'm not positive the BLS captured in its initial release.
When you look through the calendar and look ahead to the next payrolls report, September 6th, do you think we're at real risk of seeing the story flip the other way all over again?
Well, listen, the other point, you know, getting back to your first question about why I thought we're not imminently or immediately at risk of falling into a recession, when you look back at previous downturns that eventually become a recession, it takes months and months and months to go from creating 200,000+ jobs to losing jobs. You have several months where you have double-digit job growth, 80, 70, 50,000 jobs. Maybe you print negative once or twice. That was the case before 08. That was the case before 2000. It was the case back in the 90s when you started losing jobs right when the recession began. We're not there yet. 114,000 jobs, not a great report relative to recent history. But outside of recent history, I think 19 years into an economic expansion, or however long this has been, 114,000 jobs created would have been pretty good.
I think this is such an interesting point because on Monday, if you ask
That's
people...
why I made it, by
yes,
the way.
a lot of people would have said, oh, we're here. It's happened. The recession's around the corner. If it takes months and months for it to actually happen, what about the time frame when we can say it is going to happen? Is that too soon still? Or can you say, okay, it's going to take months and months, but looking down the barrel of those months, it's going to come at some point?
Well, yes, at some point there will be a recession. We can all agree.
Okay, some point in the next year, let's say.
But listen, here's the problem that you have in a free market capitalist economy like the United States is it's incredibly difficult to know when this is going to happen. If we were in China or some command control center economy, you basically you have a better idea because the state is in control here. We've got millions of actors operating throughout the economy independently of one another. There's 50,000 economists staring at the same data in the United States for all of human history, and none of us, and I'm not an economist, but I'll play one on TV for now, have been able to accurately forecast a recession. And my favorite observation on this topic is 3 or 4 months into the recession in 2008, there was still a debate about whether we were going to have one, and it had already started. It's an incredibly difficult endeavor to embark upon. I don't think this time is going to be any different. All you can look at is the totality of the data and try to come up with a framework for how I should invest in given moments. And to the way that I view things right now, we're obviously slowing down. We're returning to something resembling trend growth, certainly in the labor market for the economy more generally. And from an asset allocation and investment standpoint, what do you do in that type of environment to the best of your abilities?
What do you do in that type of environment?
Well, listen, right now, we still, I've mentioned multiple times, we find and have found stuff to do in the consumer-focused space. I've faded the excess savings argument. Obviously, that narrative is changing somewhat lately. Many more companies, DineEquity reported yesterday about a slowing consumer. Disney had some trouble in the parks, although that's not entirely surprising considering how much it costs to go to Disney. But there's been a more widespread observation about a slowdown at the lower end of the consumer space. So you have to pay a little bit more attention to that idea. But we've also liked energy. Oil has been flat for, call it 2+ years. I'm not sure everybody's aware of that. But within that context, a lot of the energy names which have focused on shareholder returns have done pretty well, from the integrateds on down to refiners and services, et cetera, et cetera. I don't know that I need to change that whole cloth right now on the idea that one labor market report wasn't as good as I had hoped.
But you even note in your notes that we got that in contrast to Dine, Hyatt is basically saying, actually, they are seeing some pretty strong bookings. So how do you really read what's going on with the consumer?
This is the ever-present problem for people such as myself who look at markets from both the top-down and bottom-up perspective. You can look at McDonald's, you can look at a number of companies that say, hey, so Visa, my favorite large market indicator, saying, yes, there's trouble at the low-income consumer. But for every McDonald's, I can give you a Chipotle. For every Dine, I can give you a Hyatt. Hyatt talked about group bookings looking incredibly strong. The casinos, the stock prices are well off the highs, but Vegas seems to be doing pretty well. So there's a lot of cross currents that you always have to deal with. I don't think now is really any different. Although, again, I think how I've looked at markets and the economy over the last 2 or 3 years, let's say, with a relatively sanguine or optimistic outlook, certainly has been tempered over the last couple of weeks by some of the data and earnings reports we've heard.
You like energy. Is that by any chance an election play?
No, and we talked about this last time I was here about the surprisingly energy did quite well under the supposedly anti-oil administration of Biden, and the converse happened during Trump. I think for us, it's been the focus on shareholder return relative to the credit markets was at many points equating some of the equities to some of the credits. It's the underinvestment. It's the exodus of people from investing in energy in the wake of what happened in 2014 and 2015 when energy imploded. It's the underinvestment. It's a number of things that we think are structurally supportive of the energy market. The U.S. is pumping 13 plus million barrels of oil per day. We're doing it with a third as many rigs. It's really, there's a lot of encouraging stuff going on in this space that we still find attractive.
It's pretty impressive. You were talking about energy there and you talked about equity versus credit. As you look at the broader set of opportunities at the moment, the ones you've identified, when you look to express them, you're seeing more opportunities in credit or equity after the reset of the last few days?
Yeah, I mean, we've been spending a little bit more time than usual the last few days on that relative argument. I think things have gotten obviously a bit more attractive. The S&P is down 8%. Obviously, tech, which is not a particularly large focus of ours, is down 10% more. Spreads have widened from very low levels, still very low for IG and high yield, just off. I don't know that the relative value argument has changed over the last couple of days, but the opportunity set has certainly widened. We spend a lot of time and have historically spent a lot of time in the media space. It's public knowledge. We were a large owner of MGM before the purchase. We've spent a lot of time there. You look at things that are going on with Disney finally turning a profit on the streaming side of the business, what's going on with Paramount and Warner Brothers, with Wolverine and Deadpool, one of the highest grossing R-rated movies of all time. There's a lot of stuff going on in there. And it's as interesting as it's ever been in an environment where there's a lot of fluctuations going on. Yeah. We still think there's tons of opportunity around that
Can
theme.
we just get to 35,000 feet and talk about high yield spreads, just briefly?
Sure.
We sit here and people will come on the programme and say spreads are too tight. And that kind of makes sense when you're at 300. And then you get a widening back to, say, towards 400, in and around. After that first 100, the same people who said that spreads were too tight and waiting for an opportunity to get in will sit here and say, I'm a little bit nervous, you've got another 100 basis points of widening
Well,
here.
the same people who say buy the dip and then the dip shows up and they run to the hill.
The same thing applies to credit. I'm just wondering, how do you approach that kind of dilemma that a lot of people have to confront in financial markets?
Well, the first thing I will say for the viewer that doesn't follow the high yield space, other than people who come on TV and point to the HYG, the high yield market is now roughly, a third of it is now roughly secured. So by definition, it is a higher quality market just from the security standpoint. So you're going to have tighter spreads as a result of that. It's also much more highly rated. Those are going to be related, of course, but it's a much more highly rated market, whereas the IG market is much more rated and leans towards the BBB, the lowest rated rung. High yield is much more leans much more to the higher rated rung. So there are structural reasons why the spreads don't have to necessarily compare to history. It's sort of akin to when you look at the stock market and you look at valuations. Yes, the equity market is more highly valued 20, 21 times relative to its history, but you're disproportionately more highly weighted to tech stocks, which of course come with a higher valuation. So you're going to have a bias to the upside there.
And in junk, we used to be more highly rated towards, say, the likes of energy. Has that changed too? Are we less cyclical in high yield now as you look at things?
Well, listen, energy is, this is a conversation for like the debate between high yield and loans, where high yield, the other thing about high yield is energy used to be a much larger part of the space, but everybody went bankrupt or graduated into IG. So energy and that one area that's constantly been a problem for high yield isn't as prevalent today as it was historically because of what we went through in the middle of the 2010s and then in COVID. But from our standpoint, again, the recent sell-off, arguably unjustified from our standpoint, has opened up a couple of more opportunities that previously might not have been there because of how tight spreads were or how highly valued markets are. But I also think you need to be a little careful here. for the reasons that we talked about earlier. The economy and the jobs market and the risk landscape is not exactly the same as it was several weeks ago, certainly, and several months ago, more assuredly. There's just, I think you're in one of those moments where in the previous months, I'm very optimistic. I faded a lot of the more bearish arguments. I don't think you can do that as easily now.
Interesting. Appreciate the clinic. It's good to see you.
Always my pleasure to come, guys. Thank you very much.
Thank you, sir. Thank you. Dan Greenhaus there of Solus. Let's get you an update on stories elsewhere. Let's get you the Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. A tsunami advisory has been issued for parts of Japan after a 7.1 magnitude earthquake was reported off the coast of its southernmost main island, Kyushu. Officials in Japan say the quake occurred just before 5 p.m. local time at an undersea depth of about 18 miles. Local residents were warned to leave coastal areas immediately. There have been no reports of any structural damage to buildings so far. Eli Lilly shares are rallying in the pre-market, up 10% after the pharma company boosted its revenue guidance for the full year, now projected to come in well above the average analyst estimates. The increases were primarily driven by strong performances of diabetes medications Mounjaro and Zepbound. The company plans to launch single-dose vials for Zepbound in the coming weeks. And NASA is now saying the two astronauts stuck in space due to problems experienced by Boeing's Starliner may have to hitch a ride back to Earth on a spacecraft built by Elon Musk's SpaceX. NASA representatives announced the contingency plan yesterday, saying astronauts Barry Wilmore and Sunita Williams will come back to Earth around February 2025 on SpaceX's Crew 9 mission. Originally, the two astronauts were supposed to stay on the station for roughly a week, but have now been in orbit for 2 months. That's your Bloomberg Brief. John?
You thought delays at the airport were bad. Can you imagine that? They'll pick you up in 2025. It's a bonkers story. Up next on this program, courting the union vote.
To me, this election's real simple. It's about one question. It's a question we made famous in the labor movement. Which side are you on?
That conversation up next, live from New York this morning. Good morning. Equities on the S&P look a little something like this. We're just about positive, erasing this morning's losses. Just about positive. In the bond market, a bit of a rally, not much of one. We're down 2 basis points on a 10-year. After the rally you saw Monday morning, I don't think you can call anything else a rally when you're just moving a couple of basis points. 392 on a 10-year. Under surveillance this morning, courting the union vote.
To me, this election's real simple. It's about one question. It's a question we made famous in the labor movement. Which side are you on? On one side, you got a billionaire that serves himself and his billionaire buddies. And on the other side, we got a strong, intelligent, and I'm just going to put it bluntly, a badass woman.
Here's the latest. Kamala Harris calling on United Auto Workers leader Shawn Fain to speak at a rally in Michigan, underscoring the importance of the union's endorsement of Harris in a key battleground state. Harris continuing her swing states tour with a stop in Arizona next, while former President Donald Trump rejoins the campaign trail with a rally in Montana tomorrow. James Lucier of Capital Alpha Partners writing this: I expect Harris will open a lead over Trump after the Democratic convention, but the race will tighten in September. James joins us now for more. James, let's get straight to it then. Where's that race tightening coming from? What are the forces behind that you expect in September?
Well, there's always a bounce when a candidate has a honeymoon period. There's usually a bounce going into a party convention, which, let's face it, is a 4-day infomercial for the party. The balloon drops, the excitement, the celebrity endorsements. So Kamala Harris has already done quite well with her initial announcement. She's had a flawless rollout. She's had a good honeymoon. And she's also benefiting from what I would call a relief rally among Democrats who realized that there was literally no way Joe Biden could win after the debate. It became clear that he was really a greatly lessened candidate, even than he was 2000. So she's benefited from Democrats coming back. On the other hand, though, once the initial rush is over, people will be focusing on issues again, not just the excitement of newness, but immigration, inflation, the crime, the national security, and those core issues where, even though Biden and Harris were tied in the national polls, we're still seeing, at least so far, polling on issues, whereas Trump tends to lead on key issues like immigration, economy, and national security, law enforcement, whereas Harris generally does much better on things like abortion rights.
So, James, when it comes to her VP pick, is this someone that could potentially help her in those top two issues that Trump does better on, immigration and the economy?
I don't think so. I think that he is a safe choice and a good choice who may help in the upper Midwest, certainly may help deliver key states like Michigan or Wisconsin. But just as J.D. Vance was the safe choice for Trump, I think it's also the case that Walz is a safe and comfortable choice. Not that it's a bad choice, but I think that there might have been a greater upside with a more centrist candidate and somebody who was frankly the rising superstar of his generation, who is Josh Shapiro of Pennsylvania. The problem is, of course, has become very evident in the past couple of days. Shapiro is not going to be on the ticket as a second banana. He probably would have overshadowed Harris. So going with Walz is probably better, all things considered, at least for Harris.
There is this consensus that Governor Walz of Minnesota could speak to those in Michigan, to those in Wisconsin. Do you believe that?
Well, it depends on speaking to who. In Metro Detroit, quite possibly. Michigan is a state, like most other states, like Minnesota, where you have strong urban populations, which are very solidly Democratic, and then you have very conservative rural, small town portions of the states. So, I don't know if he's going to be a game changer in Michigan. Clearly, he's got a profile rather similar to that of Gretchen Whitmer, the popular governor, same abortion background, same focus on COVID and COVID prevention. But we'll really have to see whether he is someone that can excite the UAW. One of the key concerns with the auto workers has been that the move to electric vehicles is going to obsolete their jobs. And Walz is clearly someone who is a very strong proponent of the green agenda and the green energy agenda that a lot of union workers are simply uncomfortable with.
James, though, these concerns, they all seem in the background, at least for the campaign at the moment, as they don't really address them, just riding this wave of enthusiasm. When September comes around and the polls do tighten, are they going to need to change?
I think that we'll have to drop, I think certainly for Harris, she needs to start doing interviews at some point. She needs to start talking about the issues. With the campaign where we're down to about 90 days to go, every day that you can win simply by doing nothing, by having photo ops, by having rallies, that's a day that you can bank. But we really haven't seen the Trump campaign respond yet. And I expect that they will. I think that they're going to focus on these core issues. And they've got an enormous war chest, in terms of money they could use on television commercials and direct media. So at some point, this Trump response is going to come. It likely would come after the Democratic convention, because otherwise you'd be shouting into the wind. Elections tend to become very, very competitive after Labor Day when people start paying attention, and also early balloting starts.
James, appreciate it. As always, thank you, sir. James Lucier there of Capital Alpha Partners. I've got a structural bias. As a journalist, of course, I want to see one of the leading candidates sit down and actually answer some questions. It is remarkable that we haven't seen that happen in much of the last 3 weeks.
It is, but to James's point, any day they can go out, have a photo op, get thousands of people to come to your rally, you bank that as a good day. She's not being forced yet, and I think that was J.D. Vance's point yesterday, going over to Air Force Two.
Trying to get the media to put some
pressure. To the media to say, don't you want her to sit down and have an interview? But at some point, she's going to have to. Also, another thing he said, when it comes down to the issues, it's Trump.
It's not happening right now. Coming up on the programme, shares of Warner Brothers Discovery tumbling in the pre-market. The company writing down the value of its TV networks. That's next. For those of you following the political campaign, just a note for you, 2 p.m, Mar-a-Lago. The former president of the United States, Donald Trump, will be doing a news conference. That's one to watch a little bit later this afternoon. For the rest of you following the economy and financial markets, we are 60 minutes away from jobless claims in America, and the scores going into it look like this. Equity futures just about unchanged on the S&P, just about positive on the NASDAQ. As things stand on the S&P 500, heading towards a fourth week of losses. If it holds, if it sticks, I think that's the longest weekly stretch of the year so far. That's the equity market. In the bond market, really the epicenter for some of the nerves yesterday, just a sloppy, soft 10-year auction. We get a 30-year auction a little bit later this afternoon. 30-year supply coming at 1 p.m. Eastern time. Yields coming in across the board here. We're down about 2 basis points on a 10-year at 392.45. And just to round things out with dollar yen, the move high yesterday in dollar yen, we retraced some of that. Dollar yen down by about 0.5% at 146. Some encouraging words to, was it to sell the Japanese yen yesterday? What do they want us to do with the Japanese yen over in Japan? Because now I'm just confused.
Presumably just not swing. I mean, either direction. I feel like that's what they wanted, but they kind of didn't get that. Because if you have a deputy governor coming out and saying, we're not going to hike rates as long as things are volatile, you get a market that, one, continues to test them because the yen will do that to you. And two, you get a swing in the other direction because people say, oh, great, it means that they're not going to hike. They're not going to hike. Therefore, we can go back into the carry trade and wonderful, everything's as it was. But is it? I mean, we had Bank of Japan minutes. It doesn't suggest that we are.
Story's changed in about a month, hasn't it? Because when we were back at 160, they wanted you to buy the Japanese yen. Dollar yen was too high. The yen was too weak. And then we gapped lower through 150 into the 140s. And it's no, we don't want that. We don't want that. What do they want? Stability around what? They just want this gradual smooth path back towards 110, 120?
Presumably, and presumably they don't want all the speculative shorts in there. Presumably they don't want this buildup of a carry trade. So couldn't you say, okay, Monday was painful, but maybe it was a good thing for them? Maybe they wash out all this excess positioning that allows the currency to bounce like that. So it's interesting that they come back out and undo some of that work.
It's the latest on dollar yen, just about 146, 145.99. Under surveillance this morning, of course, we're counting it down to jobless claims at 8:30 Eastern time. The median estimate in our survey expecting a print of 240, down from 249 last week. Following that, we'll get some Fed speak from Richmond Fed President Tom Barkin at 3 p.m. Let's deal with the data. I just received some of my favorite data. It comes from Bank of America and the Bank of America Institute. Consumer checkpoint, facing hurdles or the high jump. There's some great data in here. If you can reach out to B of A, reach out to B of A to get hold of it. But I'll share some of it with you right now. They say while the labour market is showing some signs of cooling, after-tax wages and salaries continue to grow, and there's no obvious signs of a surge in joblessness. A small uptick in year-over-year growth of households receiving unemployment benefits through direct deposits across all income groups. Just a small uptick. Then the one that stands out for me, and we covered this with Brian Moynihan a number of months ago. This always surprises me. Median deposit balances remain almost 40% above pre-pandemic levels and over 15 percentage points above inflation-adjusted 2019 levels, but they have declined to near their lowest post-pandemic levels. So deposit balances are still pretty high. But if you're interested in the trend and where things are heading, you have to acknowledge that things have come in a little bit over the last few months.
That's what everyone's been arguing about all these data points. The level is fine, but the trend is worrisome. But you know who else has had the same tone that Bank of America is talking about is Jamie Dimon. Jamie Dimon was speaking yesterday and said he's even skeptical that inflation is going to go down to 2%, that he's been looking at his own internal data and credit card losses have normalized. That trend has stopped. So he's over here worrying about inflation. Here we all worrying about the labor market. What happens if next week CPI comes in hotter?
This is why Mohamed El-Erian has been saying the Fed should be targeting a range of 2 to 3%, so they have a little bit more flexibility. Looking at this data as well, Jonathan, from Bank of America, services spending was stronger than goods. International travel. This is pretty much what we heard from the Disney CFO yesterday, and why potentially they're dealing with some of their parks not getting as many visitors remains a highlight. Consumers flocking to Paris Olympics and Taylor Swift conference, but they do see consumers becoming more price sensitive, something else we've been hearing constantly on these earnings calls.
The next big stop for this conversation, not just got jobless claims in about an hour from now, but also retail sales. Danny's talked about that repeatedly. That's a week today. Retail sales is just around the corner. The day before that, you'll get CPI. The day before that, We get PPI. So next week is quite a week for economic data. I want to turn to this story. Iran's president telling his French counterpart Emmanuel Macron that the United States and Europe must push Israel to accept a ceasefire in Gaza to reduce tensions in the region. The call is the latest in a wave of diplomatic activity to try to cool tensions, with Israel bracing for retaliation following the killing of a top Hamas leader in Tehran. We've been bracing for that retaliation now for the best part of a week.
And we're trying to read the tea leaves that what's coming out of Iran, but also what's coming out of Lebanon. And we heard from Nasrallah yesterday. But before he spoke, this is what's interesting, and Axios picked up on this. There was an editor-in-chief of the Lebanese newspaper publishing a front-page article that said Hezbollah is likely to target Tel Aviv as part of its response. And there's more reports yesterday, Jonathan, that maybe before Iran responds, we'll actually see a response from Lebanese Hezbollah.
How much pressure are we getting out of the United States at the moment from the White House?
I think there's a lot, but it's been behind scenes, behind closed doors. And I imagine there's a ton of pressure from the United States to go directly to the European counterparts like Emmanuel Macron to put some of this pressure on Iran.
That's the latest in the Middle East. I just want to check out one stock. Warner Brothers Discovery is down in the pre-market by more than 10%. We're negative 10.5 this morning. Shares tumbling as the CNN and TNT parent company writes down the value of its TV networks as it deals with the ongoing exodus of viewers from cable to streaming services. Bloomberg's Charlie Wells joins us now for more. Charlie, fantastic to touch base with you, sir. Can you just walk us through the difference between a bad market and poor execution? Where is this company at the moment?
Yeah, I mean, I think the market is still digesting what they were hearing on yesterday's earnings call. And I think, management was very clear to talk about the difficulties, not just in this company, but also in this market. But when you look at that write-down, over $9 billion. I mean, that figure itself is really striking. But you've also got to step back and remember that Warner Brothers Discovery tie-up is only about 2 years old. So how is this happening so quickly? How is that secular trend that we know about of people moving on from cable, how is that happening so quickly to the tune of over $9 billion in just over 2 years?
Charlie, how much of this is also just about the advertising market? I mean, advertisers have a lot more choice now. They got a Netflix tier, they have a Disney tier, they just have more that they could go to besides linear TV.
They've got a lot more real estate. And I think what's also frustrating for these companies is that they are getting advertising on streaming. And when you think about streaming at Warner Brothers, when you think about streaming at Disney, they're actually performing a lot better than people expected. But the issue here is just the bulk of revenue for a lot of these media companies comes not from streaming, but from that terrestrial television where the ad dollars are just stronger.
Well, one of the advantages that they did have in the past, Charlie, was a monopoly over live sporting events, and that's changed. Where do we stand on the competition to show those programmings?
Yeah, I mean, this is the rare bright spot in terrestrial programming for these large media companies. And of course, we know that with Warner Brothers, there was that disappointing for them decision for the NBA to go elsewhere. They're in the midst of litigation, and this was a hot topic on the earnings call yesterday. Of course, management saying they think they have a strong case, but of course, it's working its way through litigation right now.
Charlie, Bank of America put out a note about Warner Brothers Discovery saying that, they need to consider other options, including a breakup, a sale of certain assets, and they say everything should be on the table. What is the company saying is on the table?
I mean, look, so that is something that media companies don't like doing. I think there's, it's media. There's an emotional connection to a lot of the properties they have. And a lot of these properties, CNN, they're historic names. But I think, look, management yesterday on that earnings call said all options are on the table with a suggestion that, that is on the table. But, other strategies to kind of spin this forward that they talked about were the promise of international. I think, anyone can talk that game, though, and it's tough trying to expand abroad. And they also talked about joint ventures, not just abroad, but also domestically. And let's remember that Warner Brothers and Disney do have that JV coming up, but there's an issue with these joint ventures, right? You lose control, you lose that revenue control, and also going forward, you lose that customer data exclusivity.
Charlie, wonderful to get an update from you, sir. Thank you. Charlie Wells there of Bloomberg. Out of London on the latest. The difference between what you hear from Warner Brothers and what you heard from Disney, just in a word, confidence. The confidence you heard from Disney in the streaming business, compare that to what we're seeing from Warner Brothers Discovery, night and day.
And you have the awkwardness that you mentioned, Anne-Marie, that you get these analysts coming out and saying you should break up your company that you only just put together 2 years ago. And I really think about this from an advertiser's point of view. Who would you rather give your ad spend to? Linear TV that has less viewers, Or someone like Amazon, who literally knows every single data point about their audience, and they can do incredibly targeted ad. They're losing this war on multiple fronts.
But that's the thing. It's these targeted ads, and streaming offers that. And if you look at some of the political spend we've already seen, top of the pile, especially for the Democrats, $111 million I saw yesterday going to streaming. So that's where the money is right now. But investors aren't there just yet. And also, it's a political season, and they're having to write down cable networks.
I know. Look, it's odd to talk about the news on the news, but ultimately, for that news organisation, still struggling to work out what they want to be based on what you've seen in changes in the lineup and strategy. It seems to be all over the place still.
Changes in the lineup, also changes in editorial direction. And they really seem to struggle coming out of the Trump administration on who their audience is as well.
Many news organisations have. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. Russia has declared a state of emergency in its western region as Ukraine's military launched what appeared to be its biggest incursion into Russian territory since the war began. President Vladimir Putin summoned his top security and defense advisors to brief him on the effort. Ukraine has targeted positions and energy assets well within Russian territory, and right now European natural gas is trading around the highest levels of the year as concerns spike over disruptions to Russian fuel crossing Ukraine. The summary of opinions from the Bank of Japan's July 31st meeting showing officials didn't see their rate hike as policy tightening. The comments suggesting they didn't expect the move to be big enough to disrupt global markets. This coming after the BOJ said yesterday it won't raise interest rates when financial markets are unstable. And Liberty Media, which owns Formula One, says an investigation has been opened by the Department of Justice over the decision to reject an application by Andretti Racing to enter the motor racing competition. Andretti's bid to become the 11th F1 team was rejected on the grounds the team couldn't be competitive with the rest of the field for at least another 2 years. But earlier this year, a group of U.S. senators cited concerns F1 may be acting at the behest of foreign automakers to exclude the team because of its partnership with GM. That's your Bloomberg Brief. John?
Yahara, thank you. I, for one, don't want extra teams on the grid. Just my opinion for whatever that's worth. Not the company's opinion, my opinion. Do you want extra teams on the grid?
I don't want extra teams. I don't want all of these races because I do nothing with my life now except watch F1. And when it's not on, I'm watching the Olympics.
So you'd like a tighter calendar?
Yes,
fewer
please.
Races, fewer teams?
I just want my Sundays back. That's all.
Are you complaining about someone else, or do you actually like Formula One?
No, I like Formula One.
Okay,
Yeah,
good. Just trying to work out if there's a problem at the Berger household.
No. It's mutual. We all like F1 in the household.
Good to know. As we count you down to jobless claims, 8:30 Eastern, the number we're looking for is 240. The previous week was 249. If you want to understand what is a good and a bad number, anything down in the low 200s is absolutely phenomenal on a historical basis. But we are looking at the change here, and we've started to gap higher on jobless claims, which is concerning, particularly when the likes of Bill Dudley, the former New York Fed president, start talking about this reinforcing mechanism that we may well have activated in this country. So numbers to look for a little bit later. A playbook, a guide, if you will, from Andrew Honhorst over at Citi. Initial claims remaining at these levels in August would confirm the slowdown, and a rise to 260 or above would signal deeper weakness. Citi and Andrew have said this a few times. 260 is what they're calling the so-called danger zone, just in terms of the direction of travel, the momentum and the pace of this move higher in claims. That number drops at 8:30 Eastern Time. Up next on this program, the bond rally losing momentum.
The challenge for bonds is there's, over 100 basis points of easing priced in for the rest of the year. And if you don't get that, total return performance in some of these short maturity fixed income securities will be challenging.
We'll continue that conversation next from New York City. You're watching Bloomberg Surveillance. We're talking about the same thing, jobless claims a little bit later on this morning, 8:30 Eastern Time. Neil Dutta, Renmac, wrote this. The unemployment rate has climbed for 5 of the last 6 months and is running 0.3 percentage points higher than the Fed's year-end SEP estimate. SEP, the summary of economic projections you get from the Federal Reserve, which will get an update in September. The ongoing slowing in inflation means that monetary policy was already too tight. Stop making this about the stock market. It isn't. In the view of Neil and so many other people, this Federal Reserve is offside. They need to correct interest rates. And for the likes of Bill Dudley, Bill thinks that's like 100 basis points offside. He thinks we need to see a big move here.
I think one of the problems is you listened to Powell last week, and he basically said, look, this is a stronger jobs market than it was before the pandemic. And you just take claims on its own, and it's really hard to make that argument. Claims before the pandemic running something like 211 on average. They're at 238. Claims are higher than they were before the pandemic. So I think you can look at that and say, clearly, when it comes to this labor market, the Fed is offsides.
Just slowly creeping higher, moving in the wrong direction. Let's check out the price action. Equity futures on the S&P just about positive by 1/10%. In the bond market, yields yesterday shifting higher off the back of a sloppy auction, just about unchanged on a 10-year now, 393.60. Under surveillance this morning, the bond rally losing momentum.
The challenge for bonds is there's, over 100 basis points of easing priced in for the rest of the year. And if you don't get that, total return performance in some of these short maturity fixed income securities will be challenging. We're probably not going to see a big repricing higher in yields. And I think it's probably more going to be, how weak does the data get? Can that drive even faster Fed expectations? But base cases, we've repriced yields, and we're probably just, I think, going to sit around these levels for a while.
So here's the latest. Treasuries holding steady. Traders spurning a sale of 10-year notes at lower yields and a sign that the recent bond market rally may be losing some momentum. Tony Rodriguez of Nuveen writing this. We expect the 10-year to end the year close to 4%. We believe we have seen peak curve inversion and expect the curve to remain close to flat moving forward until it steepens more in 2025. Tony joins us now for more. Tony, good to see you.
Good to be with
Two
you.
time frames there. So we've got going into year end, then we've got a different theme added to 25. Let's start near term. What are the forces going into year end, which basically leaves this bond market where it is at the moment?
So right now we think the forces that leave the longer term bond market where it is at the moment is that we have a slowing economy. So the Fed has moved from a single mandate, inflation fighting only, to now a more balanced mandate where the risk to the employment market is becoming front and center. We think that is going to shift to where that is the primary driver of Fed activity. So when we look at the long end of the market, we think that's already priced in quite a bit of that slowness, right? We were in the high fours, we're now in the high threes. We think 4 is kind of fair value. It's the funds rate that has not caught up yet to the market, and we think we'll certainly begin that process in September, but they're behind the curve in terms of where the funds rate is today.
Just help me understand something. On inflation, are you just acknowledging they're going to accept a higher inflation rate above target inflation, or do you just assume that inflation will come down as this economy decelerates?
We think that inflation will come down as it decelerates. It's going to be slow. If you look at where we are right now, core PCE 2.6 year over year, but 3-month annualized is at 2.3. So we're moving in the right direction. We think we'll end the year around this level, 2.6, 2.5. But by the time we get to the middle of next year, we'll be down into the 2.3, heading towards 2% early 2026, we'll call it. So it's going to be slow and gradual. But while that is happening, we think we slow down from a growth pace of what's been 2.5 to 3 down to more of a 1.5%. And that's when at that rate of growth, you're certainly more susceptible to any kind of exogenous shocks that might hit the economy. Things like what we saw with just market volatility over the last week. So that's where we think the Fed's going to have to react a little more aggressively as we move through the next couple of quarters to get the funds rate in line with where we see longer term rates.
I want to ask about that volatility and where it leaves us specifically with credit. Because you've had this type of move that you haven't had for some time, that is widening. Take high yield spreads in the past 3 days blow out to 67, that is through Monday, and then they have coming up into today. Where does that leave us?
So we think that it leaves us today much closer to what we would call fair value. When we were sitting at 300 over in high yield, we were sitting at 90 over in investment grade credit. That was clearly pricing in quite a bit of good news. Solid credit fundamentals, continued growth, steady pace of maybe, rates coming down a bit. Right now, the move that we saw, while it was big, it was coming off a tight level. So it's not as worrisome in the sense that now we're getting closer to fair value. We call it fair around 350 in high yield. We've been kind of around basically a little above and below that recently. That seems like fair value. We think there's opportunity there. If you saw the high yield market widen from here, another 100 plus basis points, that would be reflecting a more material risk of hard landing than we think there is in the market today.
Well, just looking at what happened yesterday, I'd have to assume a lot of people agree with you with just this mountain of issuance we get from investment grade companies, something like $30 billion, the most of this year. Meta has something like a $10.5 billion offering, and people hoover this thing up. People are happy to buy it. Is there some degree which companies aren't being tested, that the supply is such that people are really happy to absorb it, and some of the issues with some of these individual companies are getting papered over.
Well, when you look at the investment grade market, there is a lot of appetite there. And partly it's because credit fundamentals are solid, so we don't expect significant downgrades. We think that, whether you look at interest coverage, whether you look at debt to cash flow, those metrics, while they're a little weaker than at their best levels of the last 2 years, they're still in very solid territory. And you look at the yield that's available there, and you're getting 5.5% to 6.5%, that's a very attractive return for all kinds of asset class allocators in a very high quality, relatively low volatility asset. So supply's up 20% year over year, easily absorbed. If we saw that kind of 20-25% year over year increase in dicier parts of the market, like really low quality credit, in this environment of economic slowing, that I think would be a little bit more difficult to digest. And obviously where the supply is greatest is in the Treasury market. That's really where the balance sheet is probably weakest as we look across consumers, corporations, and governments.
I want to ask about the wobbly auction yesterday. How much do you think in investors' mind that they're actually going to start thinking about, I don't want to sound like Lisa here, but the health of the U.S. trajectory when it comes to the fiscal deficit?
We think it's going to be at the earliest a kind of mid-2025 issue for the markets. The reason we had, I think, a sloppy market is because you had this huge run over the last week. So the actual value available at a, sub 4% type of yields is really not that attractive. So that clearly moves some demand to the side there. But at that fair value level of 4%, we think auction sizes as we see them through the balance of the year, those are going to be relatively digestible. We'll have some sloppy auctions, but generally I think they'll be pretty solid. But then looking into next year, because we're not going to do anything to address our fiscal deficits, that supply is going to continue to be large. That's when I think we're going to have maybe a little bit more possibility of auctions, not failed auctions by any stretch, but certainly ones that don't get digested easily.
So you think we maybe get a repeat of what we saw briefly in 2023, coming out of the summer, going into the back end of the year, I think through to the end of October, when supply starts to matter a little bit more again and yields start to climb?
I do. I mean, we don't think it'll be a, British gilt market replay type of storyline.
A Liz Truss moment?
A Liz Truss moment, because there's just deeper pockets of demand for the U.S. asset. And as we see that slowing economy that we're expecting, clearly there'll continue to be a big flight to quality, bid to the Treasury market. And yields at 4% plus or minus are still pretty attractive from an absolute return and income perspective.
What's the dominant force then behind that 2025 steepener that you're looking for? Where does that come from?
The Fed finally catching up to the market in terms of the front end.
You think it'll be that late?
I do. I think because the market right now in the front end, if you look at 2s, 3s, 5s, they've already priced in a lot of the Fed cuts. So flat curve at the end of the year had been our forecast as of the first quarter, with some modest steepening from there. But when we talk about steepening, I'm talking about a funds rate to a 2-year that might get eventually to 25 basis points, 2s, 10s, it might get eventually to 35 to 50. So
that's the shape of the curve. That's the difference between the two. Walk me through levels. Where are those individual things?
We think it's 4% across the board at the end of the year. Okay. And then we think you can get down to like a 3.5 on the 2-year. That'd be a target level.
So you've got like Fed funds at 325?
Exactly. Ultimately, we think that's the long run equilibrium level, which is why we think the Fed right now is pretty far behind. It's at a very restrictive level right now when you look at the real yield of the Fed funds rate. So even if you took 100 basis points off of that today, you're still at a restrictive level, just not as restrictive, but probably more in line with what the current balance of risks is on the inflation side and the employment side.
Tony, this was awesome. It's great to get your thoughts. Thank you, sir.
Good to be with you.
Catch up. Thank you. Tony Rodriguez there of Nuveen. Just a programming note for you in the next hour of Bloomberg Surveillance as we count you down to jobless claims, 8:30 Eastern Time. Here's the lineup for you. Samana of Wells Fargo will speak to Bloomberg Shelly Banjo, David Rosenberg of Rosenberg Research, and Matt Diczok of Merrill and Bank of America Private Bank. David Rosenberg thinks, like Bill Dudley, that process in the labour market, Danny, has already started. It's reinforcing. We're in that phase, in that cycle right now.
And the reason that's scary is because once it gets going, it doesn't move in a linear fashion. So if it's just starting, maybe we're already too late. And the next move is you get rid of companies hoarding and the unemployment rate shoots up much higher.
Big economic data point after the commercial break in about 34 minutes' time. We'll be counting you down. Equity futures, the scores going into it, just about positive on the S&P 500. We'll see if these levels hold. In the bond market, yields a little bit lower, down a basis point. Your 10-year 393.21. And for those of you interested in dollar yen, there's many of you I know, dollar yen 146.22. We're negative on that currency pair by 1/3%. From New York, this is Bloomberg.
It's time to start the cutting cycle, but we don't see evidence of a recession yet, and the soft landing is still in play here.
I don't think the data suggests that we're going to have a hard landing anytime soon.
These trends have been underway, they're persisting, and our fear is that the soft landing could be slipping away.
The bad news is no longer the good news. I think bad news is not bad news.
The Fed needs to regain control of the economy. Unless you establish anchors, the volatility itself of the marketplace will undermine economic well-being.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
I think enough of the talk now. We want to focus on the data. We've been starved of it. We get a little bit more in about 30 minutes' time. Equity futures going into it. Your scores just about positive on the S&P 500 by 1/10%. On the Nasdaq, up a little more than that. On the Russell, a little less. We're negative on the small caps by a little more than 1/10%. That's the equity market picture. Going into this, the economic data, jobless claims. In 29 minutes' time, the estimate 240, the previous number 249. We're near the highs of the year. That is not where we want to be. Danny Berger.
It's certainly not. So if we get another high report this time, does it break the trend even higher? Right now, 4-week average is 238. And you were talking about some of the figures coming from, the likes of Citi saying that 260 is something that's concerning. I think anything that makes us push above that 238 level is worrisome. But what happens if it's just seasonality and we read too much into it and then we get strong data next week?
Confirm or deny? This is a theme. Game, if you will, that we've been playing over the last couple of days or so. Last week we saw ISM manufacturing clearly confirmed a slowdown. Saw jobless claims, the wrong kind of upside surprise, clearly confirmed a slowdown. Saw it in payrolls and the unemployment rate as well. Then we had the ISM services number. ISM services was better than expected. Didn't exactly put this story to bed. You need more of it. And this is something that Seema, Shah of Principal was saying on the programme a little bit later. You need economic data. You need to see it repeatedly come out better than expected. Just to kind of put this story to bed, you need to see better earnings as well and more dovish Fed speak. Are we going to see some more of that a little bit later this morning?
Well, what's interesting is that you need to see this as a trend, and it's hard to look at claims as a trend in the summer when there's so many moving parts when it comes to seasonal adjustments, schools are out, and also you have the weather and the hurricane. I'm interested about this range Danny's talking about because it was established in 2022. 200,000 to 260,000 is that range. So if we go above that, the market is going to freak out. But to your point, Jonathan, what is the market confirming? Because when services came in, it didn't really move that much. So basically what the market seems to want to confirm is bad news at the moment.
I've said this a million times. It's not just the United States looking at this data. It's the world, including Tokyo, Japan. So let's talk about what's happening in Tokyo, Japan. Dollar yen right now. Shaping up as follows. We're at 146.27. That currency pair negative by about 1/4%. So no drama there at the moment. If you turn to the bond market, just a broader picture of things. Cross-asset treasuries, just about unchanged. Yields going nowhere. 393. And going into this data later at the front end of the curve, the 2-year, just about unchanged as well. We're trading right now at about 397. Coming up this hour, Samana of Wells Fargo on why it's time to buy the dip. David Rosenberg of Rosenberg Research on the growing slack in the labour market. And we'll catch with Matt Diczok of Merrill and Bank of America Private Bank saying fixed income is doing its job. We begin with the big issue, the rebounded stocks failing to take hold ahead of another look at the US job market at 8:30 Eastern Time. Samana of Wells Fargo with this to say. Broadly, risk assets will struggle to break out, given uncertainty around elections, geopolitics and the economy. But this is a time to be accumulating the assets you want to own for the coming year or two. Samir's with us now for more. Samir, I've wanted to get your thoughts for a while because I know you've been less constructive over the last year or so. What is it about the last week or so that you think has opened some opportunities for people with a time horizon of, say, 1 to 2 years?
Yeah, so I think the first thing is the market reaction, right? The market finally woke up to the fact that more aggressive rate cuts will come with a weakening economy. I mean, I don't know why it's so shocked. We've been saying this for a long time, that the Fed just wasn't going to run out and cut rates in a solid economy, because that unleashes inflation, which would undo all the work that they've done thus far. Two would be valuations, right? The S&P has gone from almost 5,700. At one point, we were down to 5,100. On the Russell, 2K, we were at almost 2,400. Now we're at 2,000. So I think valuations also help. The third is the Fed's, finally there. They probably will cut in, September. They probably will go 50 basis points. So it's also good that they now have the confidence they need to cut. So when you take all those things together, and the fact that the economy probably bottoms sometime in the first part of next year, and markets tend to run ahead of the economy, we think probably in the next few months, especially going into elections, there's going to be a really good buying opportunity. So we wanted to put that marker out there.
Just to demonstrate, just to validate your views on the market, do you need the Fed to validate what's currently priced for rate cuts?
I think the Fed is kind of a little bit behind the curve, so I don't need the Fed to validate our thinking. I think they'll eventually get to kind of where we're at, which is that the economy is probably on pretty solid footing, but that they do need to get, rate cuts underway. And they probably do need to be a little bit open-minded as to exactly where the rate needs to go. Our opinion is that they'll probably do about 100 basis points this year and 75 basis points next year. I think their forecast probably call for a little bit fewer than that right now, but I think they'll eventually probably revise some of those economic forecasts down and some of those rate cuts higher.
So you've got about 7 rate cuts priced in for this year and next. Samir, why don't you like fixed income at this moment?
So the tricky part with fixed income is the long end has come down so much that at this point, it probably just doesn't pay you to take kind of that duration risk. On the short end, unfortunately, because those rates will be coming down, there's also not a lot of places to go. What we actually ended up doing as part of these, kind of series of moves is we upgraded high yield, where we've been unfavorable for a couple of years now. We took that back to neutral. You still get kind of an all-in yield of around 7.5%. And, we think that's pretty attractive, especially if you're going to start to see easing financial conditions into the early part of next year.
So I get what you're saying on the front end of the curve. Essentially, it's already priced. It's gone as far as it can. But can I look at a day like Monday and say, even though it might not have been about the fundamentals, about what the Fed will actually do, we saw a rally because it provided me some support that when equities start to fall, at least bonds do the thing that bonds are supposed to do. Can you not buy it just as a sense of a hedge?
So we are neutral on duration, and I would say we still have, even now, pretty healthy allocations to fixed income. So it's not as if we're telling people to kind of avoid it altogether. But I guess if you look at large cap U.S. equities, they have a lot of the quality characteristics that we like. And I think going forward, if you're looking out a year or two, I think that's where the return will be. Now, to your point, in the near term, could you have maybe an even more extreme overreaction on kind of the long end of the curve? Could rates fall to 3.5? It's possible, but again, as an investment, looking out over the longer horizon, it's hard to see how it outperforms equities.
Samir, you said a moment ago to Jonathan that you see upcoming ahead of the election as a buying opportunity. Why is that? Is that event-driven?
So it really has to do with uncertainty, right? The market hates uncertainty. I know it's an old adage. I know it's a little bit tired, but really it does, right? And with the elections now basically being a toss-up, we think that maximum uncertainty will hit literally right before the elections, might even happen after the elections if it's kind of a contested election. And what we want investors to do is when they look out, again, a year or two, we want them to take advantage of that, because what we've realized over time is the market can live with either administration. You may have different, sets of stocks kind of do well under one or the other, but overall, the market should do pretty well. And if that, uncertainty, if that kind of contest does lead to a bigger pullback, what we want people to focus on is the fact that corporate earnings are starting to turn around. Higher unemployment rates actually benefit corporations because they can be more selective about their hiring. Those are the things that we want investors to take away and focus on heading into that uncertainty.
Samir, that's the path forward. Can we talk about the path for the next 30 minutes or so? I'd love your thoughts on jobless claims. We're looking for 240. The previous week was 249. What are you and the team looking for from this number today?
I would say if the number causes more volatility, I think you have probably, seen 70 to 80% of the drawdown for this leg lower. If there is a retest on that initial jobless claims number, we would be a buyer. Again, I think the story's been clear for some time. The economy's slowing. We've seen it on the lower rungs. We've heard the consumer-oriented companies talk about it. It would not shock me to see a higher than anticipated number. And if that leads to a sell-off, I would be a buyer.
Samana of Wells Fargo. Samir, thank you, sir. A buyer of any weakness off the back of an upside surprise on jobless claims in 20 minutes' time. That's his playbook. The estimate right now, Danny, 240. The previous week, 249.
And there's been a lot of talk that 249, and you could see this in the data, right? It comes from Texas. It comes from Hurricane Beryl. It is temporary, and it rebounds. That's part of the reason why people are looking to this data point, to either confirm or deny some of what we saw. But it's a hard argument to make when we just got jobs data and the BLS comes out and says it's not weather impacted, and you get this whole host of people saying, hang on, it is. Are we just going to do that again today? That maybe we'll get something like 240 or even higher. And then you just get people saying, hang on, this is just seasonality.
Then once you get through this, it's on to next week. PPI, CPI, retail sales, as Danny indicated, over the next month or so. CPI report next Wednesday, August 23rd, Jackson Hole. That's a much anticipated speech from Chairman Powell when we get one. September 6th, the payrolls report. September 11th, the CPI report. September 18th. I know it's just around the corner, but I keep saying this. September 18th and that Fed decision, lifetime away. Lifetime away. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Delta Airlines has been hit by a class action lawsuit. The company is accused of failing to properly refund flyers or provide them with meal, hotel, and transportation vouchers after CrowdStrike's software outage last month caused widespread delays and cancellations for Delta. CrowdStrike is also facing lawsuits from consumers and investors over the outage. Taylor Swift's 3 shows in Austria this week were canceled after local police arrested 2 people on suspicion of planning a terrorist attack. A government spokesperson saying the decision was made by the event organizer. Officials found chemical substances at the home of a 19-year-old Austrian citizen and later detained another person in Vienna. Swift was scheduled to play the 3 shows starting Friday as part of her Eras tour. And the Olympics continue today with American Noah Lyles going for the double. After winning the 100-meter on Sunday, Lyles is looking to become the first U.S. man to win that race and the 200-meter in the same Olympics. That hasn't happened since Carl Lewis did it in 1984. On the basketball court, LeBron James and Team USA taking on Nikola Jokic's Team Serbia in the semifinals, and Team USA's women's water polo team's quest for a 4th consecutive gold medal continues in a semifinal against Australia. As for medal count, the U.S. continues to lead in gold and total medals. Behind them is China. That's your Bloomberg Brief. John?
Yahara, thank you. Shout out to Quincy Hull, 400 metres. You watched that yesterday?
I was really busy.
Amazing.
You know what was incredible? The steeplechase. I've never watched this event before. It's you have all these people on a track, jumping over hurdles, going into water. Guy, like what? What is this sport?
That was mental yesterday. Quincy Hall looked gassed coming off the final turn and somehow came back to win a 400. Just phenomenal. Fantastic day on the track yesterday for Team USA. Up next on the programme, the Morning Calls Plus, Bloomberg's Shelly Banjo on Eli Lilly and fellow drug makers. Lilly in the pre-market up by almost 12%. From New York, this is Bloomberg. "15 minutes away from economic data in the United States of America." We've said this a few times already this morning. There's so much emphasis on the jobless claims print because we don't have anything else. This is basically it for the week. Jobless claims and ISM services. ISM services earlier in the week, better than expected. Jobless claims this morning, the estimate in our survey, 240K. The previous week, 249. Talked a lot about the view over at Citigroup. Andrew Honhill's talking about the so-called danger zone at Citi. They say this: claims remaining at these levels in August would confirm the slowdown. A rise to 260 or above would signal deeper weakness. Let's see if we get that 260 or above and that deeper weakness. I can't imagine what this market looks like if we do get those kind of numbers a little bit later this morning. So they're the estimates for this morning. I want to go back to the month ahead or so, the next couple of weeks in this market, the path to September 18th and the next Fed decision. Next week's a big one. CPI, the highlight. You also get PPI and retail sales. Then it's on to Jackson Hole, Wyoming, the policy symposium for the Federal Reserve. A speech from Chairman Powell on that Friday, August 23rd, is going to be one to watch, I imagine. Then it's on to the payrolls report, September 6th. Let's see if that confirms or denies the weakness that we saw just last Friday. September 11th, another CPI report, and that's the last big one going into the Fed. So that's the month or so ahead of us in this market. It really starts again with jobless claims in just a moment. Let's take a snapshot of the market for you and look at futures at the moment. Equity futures on the S&P 500 just about positive by 0.1%. In the bond market, sloppy bond auction on a 10-year yesterday. Yields are a little bit lower this morning, 392.45. I can tell you a little bit later this afternoon at 1 p.m. Eastern Time, we get $25 billion of 30-year bonds. All of a sudden, Danny, we're talking like Lisa. We're focused on supply every afternoon.
Is this why Lisa's off? Because she knew if she would be on, this is all we'd be talking about?
She wanted a break from it, I think.
Yeah, I think so. She chose her timing well. It's funny to contrast that with what's happening in the corporate bond market. I mean, there's this huge issuance yesterday, the most of the year, and people just absorb that thing. And then you contrast that with a bond market that as soon as yields go below 4%, we decide we don't want to buy duration anymore.
Bramo texted me yesterday. She's having a great time. I'm not going to do a TK and tell you where she is. A European island somewhere. Sent me pictures. She's having a wonderful time. She's going to be back with us on Monday. That's the latest on the price action and Bramo's whereabouts. It's time now for the morning calls. First up, Bank of America lowering its price target on Disney to $120 from $145. The firm keeping a buy rating on the stock, but pointing to slowing demand for the company's theme parks. That name's down another 0.9%. I still struggle with the explanation that we got, Danny, yesterday from the C-suite. The CFO saying low-income households are pulling back, high-income households are elsewhere, but the business bounces back by the middle of 25.
And what I also can't understand is if the business bouncing back is a bad thing for the overall economy, because it's his assumption that middle incomes start to hurt, so they don't want to go on the trips abroad, so they stay more local, and then they go to the theme parks. If that's the calculation, Disney doing better could actually be bad.
That stock is down by about 0.8%. Let's turn to another call for you. This from Citi, downgrading Bumble to neutral from buy and lowering its price target to $6. The firm citing the company's disappointing outlook and lack of turnaround guidance. That name, that is not a typo. We're down 40% in early trading. And your third and final call from Berenberg, lowering its price target on Merck to $135 from $143. The firm keeping a buy rating on the stock, citing surprise disruptions for the company's HPV vaccine sales. Elsewhere, fellow drug maker Eli Lilly gaining in the pre-market thanks to sales of weight loss therapy Zepbound. Bloomberg's Shelly Banjo joins us now for more. Shelly, great to see you. Their stock is up by more than 12%. Walk us through what's working over at Lilly.
I think this is sort of a moment in time to say that Eli Lilly might be pulling ahead of this race with Novo to get these weight loss drugs out there. Novo was first, but not necessarily sort of a lesson that like you can be first, but not necessarily best. You can be second and come from behind. And that seems to be the case, at least for right now.
What's behind the better execution? Why are they able to supply this in a way that the other side can't?
So both of them are facing supply issues, but Eli Lilly is starting to see those supply issues ease a little bit. And we actually had a scoop last week from Dave Ricks, the CEO, saying we think we are going to come off of shortage pretty soon. And what that means is that could change the game entirely, get them even more customers, and also reduce the amount of these compounding drugs, these sort of knockoff drugs that are not generic but not brand either, and get more people onto those branded drugs.
Can I ask you about those? Because this I find so strange. All you have to do is watch some commercials or look online. You see people advertising for not Eli Lilly's drugs, not Novo Nordisk, something else that's weird. What's going on here? I mean, is there not regulation? Are people not in danger of using these not exactly weight loss drugs, but marketed as such?
Yeah, so the FDA does not regulate this corner of the market, and it is regulated by state pharmacy boards, and so there is a sort of oversight of these. It's perfectly legal at the moment because as long as these branded drugs are in shortage, then these compounding pharmacies can make these. And compounding pharmacies are not anything new. They've been around. Actually, that's the way things used to be. Pharmacists would mix, little drugs and put them together. But the thing is, you just don't know as a consumer what exactly you're going to get, and the regulation is just not as high there.
So to your point, maybe it's a healthy thing for the overall market if Eli Lilly can pull ahead and get some of its supply out there. How much does it change the game if Roche comes out with a pill?
Well, that is the big game changer, is that it's not just Roche, it's everybody is trying to get into this game. And as we've seen with Lilly and Novo, it doesn't necessarily matter if you're first, as long as you have a product that people want to buy, especially with the market being so big. And as more people get accustomed to everyone that they know being on these drugs, it becomes more regular and the market keeps growing bigger.
When you look at the generics market, there's a huge push in Washington to get these companies to allow generics. When can we see that?
I mean, I think we still have a little bit of time here. I mean, Bernie Sanders has been going really hard, in particular on Novo. They want to bring these prices down. One thing that's interesting about Lilly's drugs is that they are actually cheaper than Novo. It's about $1,000 a month instead of $1,300 a month. And so these are starting to get cheaper, but they are weighing on health plans, not just company health plans. All these folks are really starting to see the bite of what insurance coverage is on these things. And so what Bernie Sanders and others have said is, why can I get this same drug so much cheaper in Europe than I can in the U.S.?
John brought this up yesterday. Is it a drug or is it a treatment? Because I imagine to get those insurance benefits, it has to be for a drug.
So and that's sort of what we're seeing now, is that we had this really wonderful story out. I encourage everyone to read it, about a town in Bowling Green, Kentucky, that has the highest percentage of people on these prescription drugs. And one thing that our reporters, Madison Muller and Devin Leonard, found were people who said, I was taking these medications, and then my weight loss, worked. My weight dropped, my blood sugar, all these things, got under control, and then I lost my insurance coverage. And so it's like, well, and then if I want to keep going on these drugs to keep all that stuff in check, I'm going to need to be able to pay for it somehow. And then that enters the compounding market, where people are then shifting to some of these other kinds of drugs. And so it's a little bit of a mess.
Has the opportunity to revolutionize this economy, given obesity rates of what, close to 40% in the United States?
It is a huge addressable market, and then you get all these kind of side effects. It's like, are gyms going to be more popular or less popular because people have lost weight?
Good point.
Of all of a sudden, are we all buying Lululemon because we're happy about our bodies and feel good about how we look? Is Krispy Kreme going to all of a sudden go bankrupt because people aren't buying donuts? I mean, it has really wide-reaching repercussions.
Shelly, it's good to see you. Great story, by the way. Shelly Banjo there of Bloomberg on the latest, with Eli Lilly up in a pre-market by more than 10%, up by 12.5 right now. Jobless claims are just around the corner. Mike McKee's dropped by to get you all up to speed on that. Mike, walk us through what we need to look for in about 7 minutes' time.
Well, a couple of things we need to look for. One is obviously the level of initial jobless claims and whether it goes up or down. It would be no surprise if it went up, because seasonal factors push up jobless claims at this time of year. This may be the last week in which that happens. So we also want to look at the non-seasonally adjusted claims, because those would have to rise if we were getting a lot of layoffs. So it may be a seasonal adjustment problem. It may be economy and labor market weakening problem. We just don't know. And we also want to see what the jobless claims numbers are from states like Texas, and see if the hurricanes are starting to, so to speak, wash out of the claims numbers.
Mike, is that enough, doing all that legwork to wash out all of the noise and get a clear signal? Or should we approach this kind of tepidly to say that it will have seasonality oddities and don't read too much into it?
Well, you're right, Danny. That's the way we should approach it. But will Wall Street approach it that way? That's the question. I mean, you have people essentially looking for reasons to sell on the idea of economic weakness. And so if we get any kind of significant rise in jobless claims, you'll probably see a negative reaction to what's going on. Now, Ian Lingan of BMO, you had him on yesterday. He's talking this morning about how we haven't seen rates really move since the Fed meeting, since right before the Fed meeting. We had some volatility between then and now, but we're about where we were. So markets have already priced in weakness. The question is, do they sell even more and price in more and push yields up?
Mike McKee, thank you, sir. Looking forward to catching up with Mike in just a moment. That number drops in about 6 minutes' time, 5 minutes away. Jobless claims. Mike's going to break it down for you. Then on the programme, we'll be catching up with David Rosenberg of Rosenberg Research and Matt Diczok of Merrill and Bank of America Private Bank. Danny, to Mike McKee's point, how the market responds to this data point might be very different to how Federal Reserve officials respond to this data point, because what we saw on Friday was a market get very, very spooked by payrolls. And what we've heard so far over the last few days from Fed officials, they don't sound spooked at all.
That's why I'm so looking forward to when Barkin speaks today, because among all of them, he's been very nonchalant. Last time he spoke Friday after the jobs numbers, he said, well, if we had have hiked, there probably would be people out there who still would have criticized us. We can't win either way, so we're just going to do us.
I thought they were blessed with criticism. I thought that's what Chairman Powell said. I thought we blessed them.
I think Barkin might
didn't
disagree on that.
See it the same way.
Yep.
I don't think Chairman Powell sees it that way either. 240 is the estimate in our survey for jobless claims. 249 the previous week. The number up next. Have we ever talked about jobless claims this much? It feels like in some places in the world of economics, jobless claims today being treated like payrolls. A lot of weight being put on this number. It drops in about 15 seconds time. The estimate is 240. The previous number is 249. Mike will breathe some life into the conversation on continuing claims as well. That number drops in just a moment. The scores going into it. Equity futures just about positive on the S&P 500. Just about positive likewise on the NASDAQ. With economic data, here's Mike McKee. Good morning, Mike.
Well, we have some good news, or I don't know what counts as good news these days. 233 is the number, 233,000 initial jobless claims, significantly lower than the 240 estimated and the 247 that was the whisper number. So we are retreating back a little bit, and that is not unexpected. I mentioned earlier we have seasonal adjustment effects in the month of July, and that seems to be what's happening. Continuing claims, 1,875,000. That is down from the previously reported 1,877. By the way, the previously reported initial jobless claims for last week revised up to 250,001. So it makes the drop a little bit more, 17,000. But it is a drop in that number. Now, I'm waiting for my numbers to come up for the non-seasonally adjusted. Takes a while these days with the internet, and I'll bring that to you in just a second.
You wait for that, Mike. I'll go across to the equity market. This is how much weight the equity market was putting on this jobless claims number. We're up by 0.6%. I don't know if this move sticks, but it just gives you an idea of how much weight some market participants were putting on this number this morning. The Nasdaq 100 up by 0.8, the Russell up by 1.4. We'll see if these moves hold. Yesterday, they did not. We'll see if they hold throughout this morning and into the afternoon. In the bond market, Treasuries lower, yields higher. We're up by 5 basis points on a 2-year. We're back through 4%. On a 10-year, we're up by 3, getting closer and closer to 4% all over again. And if you're in Tokyo, Japan, at the Ministry of Finance, or the BOJ, and you're watching, good afternoon to you. 146.80 is where dollar yen is, just about positive now on the session. So, Danny, there it is in jobless claims. We like to say that is the right kind of downside surprise.
This market was a coiled up spring waiting for that. The biggest of the springs, I think, just going through the board is Russell 2000. And that's a really fascinating one because we used to argue that the coming of cuts would be great for the Russell 2000. Here we go, something that has knocked off the idea that cuts are imminent, are in a big way, and yet we are rallying.
Just a little bit of a relief rally in the equity market, a little bit of a sell-off in the bond market, and a bit of a stronger dollar off the back of this as well. Mike McKee, you've had an extra minute or so. What do you see in the data?
Well, let's take a look at the non-seasonally adjusted numbers. They come in at 203,000, and that was 215 the week before. So a significant change there as well, down almost 14,000. The seasonal factors had anticipated not much of a decline, and so we get a much bigger decline than anticipated there. And then when you look at the largest increases in claims, they were in Michigan and Missouri, about 4,000 each. Texas dropped by almost 7,000. So the big filings that we had after the hurricane washing out of the data, and that may be one reason. And when you look at the non-seasonally adjusted numbers, and even compared to the seasonally adjusted numbers, it tells you that while we're a little elevated over where we were a couple of weeks ago, it's not layoffs.
I will say this, Mike. It does feel like we're firmly shifted into a good news is good news, bad news is bad news regime in this market, right?
Yeah, we have, which I guess is a good thing. But on the other side of the coin is that the bad news has been bad news for this market, too. I'm just really struck by comparing at this very moment to the narrative on Monday. The narrative on Monday was literally we are heading into a recession. The Fed needs to do an inter-meeting emergency cut. Imagine if the Fed started talking like that, and then we got this number. I mean, if anything, you could say, all right, well done, Daly, well done, Goolsby, for staying so calm.
Last week, the data, not great. ISM manufacturing, jobless claims, payrolls. This week, the data a little bit better. ISM services and jobless claims this morning. To look at the totality of the data, joining us now is David Rosenberg of Rosenberg Research. David, we've been looking forward to catching up with you, sir. Let's just take a step back. Totality of the data, as the Fed would like to say. What's your assessment of where we are, David, at the moment?
Well, I still think that we're either in a recession or about to confront one. And, you know, I know everybody's on tenterhooks because of weekly jobless claims numbers, which can quite often contain quite a bit of noise. And coming off what could have been hurricane distortion from the previous week. However, I would say that what's tried, tested, and true is the unemployment rate. and the unemployment rate is up 0.9 of a percentage point over the past 15 months. And the data going back to 1948 show that we had 12 recessions. And when you're up 90 basis points or more in the unemployment rate from the cycle low, you go into recession 100% of the time. So I am definitely not one of those people that would say to you, it's different this time. I don't think that it is. And today's jobless claims numbers, we'll get a fresh batch a week today. Doesn't change my view.
David, I'm going to push you on this, and I'm sure it's something that you have heard multiple times. So I'll give you the opportunity to tell me why I am wrong. The argument of you being wrong goes something like this, that the uptrend is about immigration. Torsten Slok of Apollo out with a note just moments ago saying that more visas are getting accepted, that there's been a COVID backlog, and that just adds again to the evidence that there's growth in the labor supply, hence the uptrend in unemployment. Why is that argument not right?
Well, the argument is partially right, but the reality is, just to go back, the unemployment rate comes from the household survey, not the payroll survey. But the reality is that there's been no growth in job creation in the household survey over the past 12 months. What the data show is that 96% of those people, and I'm sure a lot of them are immigrants, 96% of the people that entered the labor force in the past year have not found a job. Now, I would pose the question back to you. Does that sound like a buoyant labor market as far as you're concerned? This time last year, 96% of labor force entrants were finding a job. Only 4% now are finding a job. So it's not just about labor supply, and it's not just about firings or layoffs, which remain very low. Companies are still hoarding labor, but what are they doing? They're cutting the work week, and they're furloughing workers from full-time to part-time. Well, you get from full-time to part-time, it's not a job loss, so you don't collect an unemployment insurance check. But there are decisive shifts taking place in the labor market right now. So there's been no growth in household employment, and in fact, if you look at the full-time picture, full-time jobs are down on a year-over-year basis. The number of full-time jobs are negative year on year. And that does not happen typically in an economy that's still expanding. That's my point.
We heard from Mary Daly recently, and she said firms are not laying off people, to your point there. So why isn't this just normalization? How can we be a recession if firms are not laying off individuals?
Well, because employment is not just one number. It's the product of two numbers, firings and hirings. And what's happening, and it's not contained in today's jobless claim number, but you do see it in the JOLTS data, and you see it in the Challenger data, which is that hiring activity is collapsing. Like, I don't know what I'm missing. We just got a few weeks ago the JOLTS data. The JOLTS data showed that the number of new hires in the economy, the number of new hires is running negative 9% year over year. And the level of hirings is back to where it was in April 2020. So what's happening is that, yes, the firing rate is remaining very low for the reasons I said before. And a lot of it is because companies have this horrible memory that is lingering about letting people go in 2020 and then not finding them again. So they're holding on to their staff, they're cutting hours, repositioning staff to part-time from full-time, and that's giving this illusion that, yes, firings are very low. But what's happening is that the hiring rate is collapsing. We got the Challenger numbers just ahead of non-farm last week. So in July, the number of hiring announcements in the Challenger data was the weakest for any July back to when the data started in 2004. The number of hires in the Challenger survey is negative 71% year over year. So you're just looking at one side of the ledger, which is firings. But the reason why employment growth is decelerating sharply, even in the payroll survey, is because hiring activity is collapsing even as the firing rate remains very low. That's the story beneath the story.
David, as you know, where there is consensus right now, a lot of people believe the Fed needs to get less restrictive. there's another element to this as well. I just wonder whether you think they need to get accommodative. And when we talk less about the path and whether they go 25 or 50 in September and talk more about the destination, where do you think they're going to end up here at the Federal Reserve?
Well, I think that Jay Powell gave us a ton of information at the podium last week at the press conference when he uttered the word normalization to describe the labor market and the economy no fewer than 11 times. Normalization. So things have normalized. You strip out the nonsense around owner's equivalent rent and the lag nature of the actual rents, and inflation is basically back to target. And the unemployment rate is actually higher now than it was before COVID, when the funds rate was 1.75. So he uttered the word normalization. The only thing that's not normalized is the Fed funds rate. And so what's normalized? Well, according to their own estimates, the neutral rate, the equilibrium rate, the rate that we should have in a balanced economy, which he said we're in, is 2.75. And every Taylor rule estimate shows that today the funds rate maximum should be 4%. We're still 5.25, 5.5. So they are ridiculously behind the curve, no matter what's happening with the equity market. And it wasn't about data that caused the markets to start thinking they're going to go intermeeting. It was, are we going to continue to get 1,000-point down days in the Dow? That was just all about the stock market. But they are ridiculously behind the curve, irrespective of what the capital markets are doing. So he basically said things are normalized, and we do not have a funds rate that is consistent with a normalized economy. So they have a long road to hoe.
David Rosenberg of Rosenberg Research. David, great to catch up, sir, to get your thoughts on this economy and where David thinks the Fed needs to be. You mentioned capital markets. We'll talk about capital markets. Equity futures right now on the S&P 500 near session highs, up by 0.8%. Check out this move on a Russell, the small caps, up by 1.6%. If you're just joining us, we were basically unchanged on the S&P 500 as of about 12 minutes ago, before we got this economic data. Jobless claims delivered the right kind of downside surprise. 233 against an estimate of 240. It's not a big swing, and yet we are seeing this massive move in the equity market and bonds as well, Danny. Yields are up by 6 basis points across the front end of the curve, the 2-year back through 4%.
The thing that I'm really struck by is that this is a market trading this as if it was non-farm payrolls, like as if it was a North Star type of report, and this it is not. Not even just that. Not even that just historically this is a noisy print, but this one specifically is a really noisy print because of things like weather, because of the things of seasonality. We've put so much importance on this report, and that's why you got the market reaction you did.
Matt Diczok with us around the table of Merrill and Bank of America Private Bank. Matt, to Danny's point, we've both been talking about it. Are we going to treat every single jobless claims print every single week for the rest of this summer, the rest of this year, this way?
It's going to be exciting. We're going to be watching for it. It's going to be a
Do you think we should put this much weight on this print?
Yes, because then people want to talk to us about it. So I think we should. We absolutely shouldn't. To your point, it's a very noisy number week to week. You got to look at the trend. But more importantly, at the start of a recession, generally speaking, weekly unemployment claims are sort of 350 to 450,000. So we're still well off the number where we see companies firing and people are getting really concerned about their financial condition. So we're not overly concerned about a recession right now. We're not calling for a recession. Certainly, the market-implied recession odds were way too low a couple of weeks ago, and they're more getting to a place that's more normal. There's a higher risk of recession than zero, but it's still not a base case for us yet.
So what do you make of the levels we're at right now in the bond market?
So for the bond market, as you know, bond guys are like undertakers. We're only happy when everyone else is sad. We've been listening for a year now, all these reasons why bonds don't work, why diversification isn't going to work, why you should have commodities, you should have something else in your portfolio. Last week was close the blue book, put your pencils down, the exam's over. Bonds did their job. We've been saying this for a year. We've been counseling getting long duration for over a year now, with real rates around that 2% level, below that now. They can do a job of diversifying. Back in 2021, when they were negative 2% real, right, when they were 50 basis points to 1% in 10 years, yes, they weren't doing their job. Now they can do their job. That was the most important thing we learned from the market, that when there is an economic downturn, when there is real market volatility, Treasuries, high-quality fixed-income collateral will protect your portfolio.
I look at the past week, though, and I say, yeah, it did a job. They did their job, but in an extremely volatile way. That you saw some big swings in this bond market. Does that dampen their ability to give you protection? That if I have bonds in my portfolio, that it could actually add to some of the volatility in it?
That's a very good question. So Mark Cabana, our head of rates research at Bank of America Merrill, he does have concern about liquidity in the Treasury market. You can flip that a little bit on its head, though. There's no constitutionally guaranteed right to be able to trade a yard at 10 years in a millisecond. So when people realize that maybe the liquidity is not quite there, right, maybe they can't take as large positions, maybe there will be an increase in risk premiums in the market. For our clients who are liquidity providers, who are looking to put money to work, higher risk premiums, potentially because of the bid-ask factors and liquidity you're talking about, is probably better for overall for investors on the whole, because that should lead to a higher term premium, should lead to higher credit spreads on average. They should get a little more compensation for that lack of liquidity. So we are a little bit concerned about it, but from an investor who's providing liquidity to the market, it can actually be a benefit.
Just to that point, do you think this week would have played out differently if it wasn't the dead of summer? If it wasn't August, if this was a couple months ago and all of this was happening?
I definitely think that was a factor. A lot of traders on their 2-week vacations now. August is a new September, it feels like. Definitely there was more volatility than we would have expected. And again, you start to see things in the market like 6 or 7 Fed rate cuts by January seem to overestimate economic weakness. It was more market technical sentiment driven.
So what do you do in a day like today when the markets are basically reacting to this claims like it's a non-farm payrolls because it's illiquid? It's August.
So one of the best things to do is just have your strategic plan in place and take opportunities like this as they give it to you. So we've been saying for a while that, again, we didn't expect a recession, but as we looked across the credit complex, we thought IG, high yield, even munis were a little bit expensive, so we were slightly underweight some of the credit sectors. But we haven't moved to an underweight position on equity. So actually, when we see volatility like this, we've been advising clients to take advantage of it, get back to their strategic targets, put a little bit of money to work. You kind of want this volatility. You want these drawdowns every once in a while to be able to add back to your portfolio.
When you get backups in yields like the ones we've got right now, do you think these are going to get bought? Do you think the last week was a wake-up call for the lazy money, if we can call it that, sitting in money market funds, getting rewarded for doing nothing, and they've been told repeatedly by individual after individual on Wall Street to lock in this yield, this reinvestment risk? That's like been the phrase of this year. Yeah. And then they've sat there and said, I don't know what you're talking about. You've been saying this for 12 months and we've had no rate cuts. Do you think this was the week where that money woke up a little bit?
I would like to think that's the case, but that's not going to be the case, in my opinion. As you said, we've been counseling for a year or so that fixed income's longer dated bonds. Cash is not fixed income, it's variable income. You just don't know how long you're going to get that cash yield for. It's going to come down. But unfortunately, what it seems like, until the Fed actually cuts, people don't actually move out of money market funds. So we're still going to counsel that. I do think this is somewhat of a wake-up call, again, that if you were concerned that bonds couldn't diversify, I think that is taken off the table now. So that will hopefully encourage clients to get back to their strategic targets at fixed income.
Did you just give us a little sneak peek of what client conversations were like this week?
Yes.
Are they still reluctant to do this?
They've been reluctant to do this for some time, which is one of the reasons you know it's the right thing to do. When it's that hard to get people to do it, you know that's probably the right move.
Why do you think this week wasn't enough for them? What did they say back to you? What did those conversations sound like?
So essentially, there's always some new concern why they wouldn't want to move it to cash, whether it's higher deficits, whether it's the fact that they can still get 5.25%, even if they cut 3 or 4 times, they can still get it. It's very difficult to make the conversation. I try to tell folks the yield curve tries to trick you. Right? When yields are that high in the short end and lower in the long end, it's trying to trick you, sort of don't fall for it. And again, we don't need to be crazy long bonds, but getting clients from a 2 to 3 year average duration to a 5 or 6 year duration is going to be better for them long term.
It's a big challenge still at the moment. Matt, it's good to see you. Thank you, sir. Matt Diczok there of Merrill and Bank of America Private Bank on the latest jobless claims print. Jobless claims Thursday is the new payrolls Friday, I guess, Mike McKee. Is that what we're going with now?
Well, at least for the time being, because it is August. Matt was talking about all the traders being on vacation. Everybody from the Fed's on vacation, too.
True.
And it doesn't give you any guidance, but I don't imagine anybody wants them to come back.
Light on data, light on speeches. Yeah, I think we'll all take that break. Mike, thank you. 233 is the jobs number, the jobless claims number, 233. The estimate was 240. So that's the right kind of downside surprise for you on jobless claims. The reaction, let's go through the boards and start with equity futures, roll through the bond market. Equity futures right now up by 0.8% on the S&P 500. Big outperformance on the small caps. That outperformance on the small caps encouraged by what's developing in the bond market. Check out fixed income. Treasury's a little softer, yields a bit higher. Up on the front end now by 8 basis points on a 2-year. To north of 4%, 4.04 on a 10-year, up by 5 to just short of 4%. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Hakes. Hey, Yahara.
Hi, John. Shares of Warner Brothers are down in the pre-market. The parent of CNN and TNT posted a second quarter charge of more than $9 billion after writing down the value of its traditional TV networks. The write-down reflects the continued exodus of viewers from cable networks like CNN to new streaming platforms. On that note, Warner Brothers said it added 3.6 million new streaming subscribers, almost double what Wall Street had estimated. Also down, shares of Bumble are plunging nearly 40% in the pre-market. The dating company reported second quarter revenue that missed estimates and slashing its revenue outlook for the year. In contrast, Match, which owns Bumble's biggest rival Tinder, jumped the most in nearly 2 years last week after the company delivered better than expected quarterly results. Eli shares are up nearly 13% in the pre-market after the pharma company boosted its revenue guidance for the full year. It's now projected to come in well above the average analyst estimate. The increases were primarily driven by strong performances of diabetes medications Mounjaro and Zepbound. The company plans to launch single-dose vials for Zepbound in the coming weeks. That's your Bloomberg Brief. John?
Yeah, all right, thank you. Appreciate this morning. Thank you very much. Up next on the programme, setting you up for the day ahead. Your trading diary just around the corner from New York. This is Bloomberg TV. Counting it down to the opening bell, about 37 minutes away. Your scores, they improve. On the S&P, up by 0.8%. In the bond market, treasuries weaken. They soften, they cheapen. Yields are higher by 5 basis points on a 10-year, just short of 4% at 3.99. As jobless claims come in better than expected, it's the right kind of downside surprise at 233,000. The estimate was 240. Your trading diary, the day ahead looks like this. 1 p.m. The Treasury auctioning $25 billion in 30-year bonds. 2 p.m. Former President Donald Trump holding a news conference from Mar-a-Lago at 3 p.m. this afternoon. We'll hear from Richmond Fed President Tom Barkin. On Friday, Vice President Kamala Harris making a campaign stop in Arizona. Trump holding a rally in Montana. Just a little bit of pressure starting to build in the last 24 hours. I think we all want to hear from Kamala Harris.
Yeah, we do. And not just when it comes to these set pieces like a campaign rally where she's off prompter. We actually want to hear what their policy proposals are going to be. How much is she going to differentiate herself from Biden? Because we do know that in the polls for the past year, it wasn't just Biden's age, but the top 2 issues when it comes to this election is the economy and is immigration. And when you ask voters, they say that it was better under Trump.
The top issue right now for this market, jobless claims, 233K. I'm pleased we're on the same page because this has felt bizarre, odd even. For the rest of this summer, I think going into the Federal Reserve decision on September 18th, it feels like jobless claims every Thursday is becoming as important as payrolls on Fridays.
We are trading it as such to the point where you can get a rally of more than 1% in small caps after jobless claims. Again, it really boggles your mind. Maybe you can say, okay, it's the summer, there's not a lot of people around, but it does just emphasize the fact that we kind of don't know where we are. There are people who have a very clear idea, and often they're on opposing sides. And when you get this trend shift, usually you have these periods of instability until you can establish a new trend. Does jobless claims establish that trend? Probably not, let's be honest. Maybe next week can go some ways to it, but again, it's choppiness until we find it.
Keep going back to that speech in Jackson Hole, Wyoming of last August, a year ago, with Chairman Powell, and he talked about navigating the stars under cloudy skies. Feels like that over the last week or so. ISM manufacturing was weak, jobless claims was bad, payrolls was not good. That was last week. This week, ISM services was decent, jobless claims were better. And to your point, this market is just stuck between the two, just getting whipsawed from one data point to the next.
I really like what Dan Greenhaus says, this idea that it takes months and months for a recession to happen. But along the road to there, you do get these signs of things changing. You do get slight changes of companies saying different things, individual data points coming in. And I think that's why you can build the argument that something is starting to happen. Maybe we're not there, but nerves are kicking in.
That start of that beginning of that self-reinforcing process that Bill Dudley was talking about. A lot of views out there. More views coming tomorrow. Steve Major of HSBC will catch up with Congressman French Hill of Arkansas, Megan Swiber of Bank of America, and Binky Chada of Deutsche Bank. The opening bout 34 minutes away. Good luck with the rest of today's session from New York City. This was Bloomberg Surveillance.